I go first, right?
Yes, exactly. Well, actually, they have this order they want to go in.
Who's first?
Mark is first, then you and Steve.
Okay.
Ends up that's what they. Welcome everybody to this session. I'm Ted Tozer, the former president of Ginnie Mae and now a senior fellow at the Milken Institute. And I'm really excited about this panel, talking about credit pricing. Again, I'm really excited here with the group. Got a really great group here. We'll kick off with Mark Pelham from Fannie Mae. And Mark is the Vice President and Deputy Chief Economist at Fannie. He's in charge of economics and strategic research. And again, Mark's going to talk about some survey information they've done on kind of their affordable products and pricing due to that. And then we'll go with Pedro Getty. Yeah. And Pedro is on the faculty here at Georgetown University. He's a professor at Georgetown and IE University in Madrid. And Pedro's going to talk about some of the regulatory issues that really kind of affect pricing of mortgages and the credit risk. And then finally, we're going to have Steve Ollinger, who's, again, it's really been is a State Farm James Q. Wilson Scholar here at the AEI. He's the co-director of the AEI's International Center for Housing Risk. And again, I'm looking forward to seeing what Steve has to talk about, because again, he's going to talk about the jumbo market pricing versus that of Fannie Freddie. And he's going to talk about some of the trends that have developed as far as the pricing let's go with that. So again, I'm excited to hear what everybody has to say. So I'll go ahead and kick it off with Mark with your presentation.
Okay, well, thank you very much. I really appreciate you including me this morning and everyone coming out this early for a somewhat dry, but I hope interesting topic. So let me see if I can bring up the slides. Okay. So this will start with this slide. This is the easiest slide. It says, I have 4 kids to put through college, so don't attribute what I say to Fannie Mae. Okay, on to the substance. So why don't we start with this one? Let me tell you a little bit about this research and what we're trying to look at. And I want to start off by saying it's joint research with Hamilton Fowler, who's here, and Grace Lee, who's not. And this is part of a longer paper, which is a working paper on our website. I know some of the print in here on the tables later on is a little small, but you can find all of it online if you're interested. So what was the motivation for us doing this work, and why did we do it? A couple of years ago, Fannie was at 95 LTV, and there was discussion in the marketplace about us going back to 97. And one of the things I do is go out and meet with lenders, do the economic update, listen to them about what's going on in the market. And lenders were expressing some concern about, were we just going back down the same route that we had gone pre-crisis? And you know, I told them, no, we really weren't, because we've tightened up our underwriting standards, we've really tightened up eligibility standards. The loans we're getting now don't have the issues they had before, and the key pre-crisis issue was risk layering, which is kind of where we left off the discussion yesterday. And they looked at me politely, so I went back to the office. I said, we really need to let some data out of the building to reassure lenders that what we're saying is actually the case. And that was sort of where this paper came from. And the other reason why I bring that up is it affects how we looked at the problem, which is the first thing we discussed at the top. The lenders at that point were really focused on buyback risk. And so we looked at you can look at loan performance many different ways, but we focused on the first 24 months and whether loans go 90 days delinquent. And then the next thing we wanted to do was to look at variables that people have at origination, right? So the variables a lender would have and would be considering at origination, things like LTV, FICO, I'm sorry to bring FICO back, so let's call it credit score, DTI, the location of it, whether it's a purchase loan, whether it's an investor loan, things that they would be considering when they underwrite the loan. And we focused on purchase loans only because, generally speaking, the policy discussion around appropriate LTV level is really about access to credit, right? And how much leverage is sustainable, as was brought up yesterday. So the way we set up the study is we looked at 3 different time periods. And the reason we did that is if you think about loan performance, there's a number of things that drive loan performance, right? The first one is borrower characteristics, things like what your FICO is, what your income is. Right? The second one is when you actually took out the loan. You know, what was the product suite that was available? What's the attribute of the loan you're taking? If you're taking out a neg-am teaser rate loan, we know that's going to perform worse, right? And we found that out pre-crisis versus a 30-year mortgage that amortizes. And then the third thing is sort of what kind of seas are you sailing into, right? If you do a low down payment loan and you have very modest income and you have very little savings and you bought your house in 2002, chances are you fared a lot better than if you bought it in the first half of 2008, right? Because home prices, if you get a couple of years of home price appreciation, it builds an equity buffer, okay? So to us, for the lender and us who are taking credit risk, there's nothing more important than equity, right? Because if you look at delinquency rates, the 30 to 60-day delinquency rates, what do you see? Over time, that number isn't 0. That number is bobbing along, and it's not, it has a cyclical component, but there's a background level of delinquency all the time. And that's driven by major medical, right? You lose your job, your spouse passes away, all the things that cause people not to be able to pay for a while. So, you know, the environment that you sail into is critical. So we wanted to look at these 3 different time periods. Let me see if I left anything else. And then the other thing, as I said, we focused on purchase. And then the other key part of what we're able to do with our data, which obviously people at FHFA can do too, and that was a terrific paper yesterday that you guys went through, is that we have the actual, you know, name, address, zip code, income information. We know exactly where the loan is, right? Most academic researchers don't have that. So they can't match to what your income is relative to your area income. And so that's the way we think of income in this paper. If you look at housing goals, if you look at how people analyze, you know, access to credit, they often do it in this way, where you're looking at what's your relative income. And one reason to do that is otherwise, if you just look at absolute level of income and you break people up into buckets of quartiles or what have you, you're basically going to have the middle of the country as low income, right? And people on the coast are high income when that's just not the case. It's income relative to the people around you. And we can do that matching because we have the underlying data. And you'll see later on, we break it down into standard groups. People less than 50 AMI, 50 to 80, 80 to 100, and then over 100 is high income. Okay, on to the first results. So this is I'm so glad we have these huge screens. Because otherwise, I sort of looked at this, I was like, oh, this is going to be really annoying. But actually, it works really well on this screen. So what I've given you here is the actual performance, and like I said, this is available online. I know it's available from Ed too, but this is, on this chart, what we focus on is just actual loan performance by different time periods, which is the second column in each case, the default rate and that severely delinquent in the first 24 months. And then we give you an odds ratio, how that is relative to currently eligible today loans that are above average income. Okay, so let me just walk you through this to show you a little bit how performance does vary by income. So if you just look at raw performance, for example, for 2002 through 2004, that's the second column, you can see the default rate for people at 50 AMI and below for that, who were originated in 2002 through 2004, that first box. I'm sorry, I don't have a pointer on here. It was 4.4%, right, in the first 24 months. If you go up the income level, you see that drops to 3, 2.3, and 1.5, okay? So those are loans that were originated in a period that might be normal, might not be normal, but it's often used as a baseline in discussions of access to credit, and maybe it shouldn't be. Maybe we should. I actually really like the paper from yesterday. There's some very good arguments for why we should use the early 90s and not early 2000s. But in the current conversation, this is often a baseline period. And then if you look on the table below, what we've done is we've said, okay, take those loans and see which ones would be eligible today, given the things that we've changed in our underwriting. Like we don't allow 40-year, we don't allow interest only. We've set a minimum FICO score of 620. take a look at the loans that would meet that eligibility and those that wouldn't, right? And see how that performance differs. And so that's the initial answer to the lenders. What has it done? What have the changes that we've made to eligibility and underwriting standards done? And what would we expect it would do to performance? So you can see a pretty dramatic improvement, right? The ones at the bottom are the ones that are currently eligible, and in the middle block are the ones that are not. So it's most obvious when you look at 2005 through 07. So for example, for AMIs below 50% that are no longer eligible, the delinquency rate in the first 24 months was 16.8%. So the fourth column down, first box. As you move down, you get down to 7.3% delinquency for the ineligibles. That's pretty high delinquency rates for conventional conforming loans. Once you only look at the ones that are currently eligible under today's standards, those numbers drop to 2.9, going down all the way to 1.1%. A dramatic difference between those two groups. Now that's somewhat not surprising. It's sort of artificial in one way, because the way we went and decided, in part, how we wanted to tighten up our eligibility standards was to look at our own data, right, and say, if we tighten and we get rid of 40-year loans, we only go to 30, we do interest, we don't get rid of interest only, we get rid of low doc, what would that do to performance? And that's part of how we drew the lines, right? So this basically substantiates that the changes in the eligibility criteria not only impact performance for low and moderate income lenders, but they actually even help high income lenders, high income borrowers. So if you look at the difference, it's a fraction, right? You go for, even for high income borrowers, the pre-crisis originations, you go from 7.3 to 1.1, a dramatic difference in the performance. And then on the right, we've got loans that were originated from 11 to 2013. And you can see, obviously, we don't have the eligible, ineligible, since they all meet the current eligibility standards. And you can see the performance here is even better than the ones from 05 and 07, and even better than 02 through 04, which is consistent with the risk index that we've seen earlier on the presentation and other people's measures. You can see how much they've declined, right? They go from 0.7% down to 0.2. The other thing you'll notice is that the relative performance, so the other question that we got asked is, do very low income loans or loans to low income borrowers perform worse than those to high income? Yes, they continue to perform worse, right? And you can see that here if you look at it as a multiple. And that multiple is pretty stable over time. There's not a huge difference. And that's not actually a shocking result, right? If you think about, if you look at the distribution of wealth in the country, you look at what unemployment variation over the cycle is for people with a high school education versus those with a graduate degree, okay? And you look at data on family structure and households and all these other things, it's not surprising that when a recession hits, very low-income borrowers are going to perform a little bit worse, right? And they're going to perform meaningfully worse than they did. Now, what we haven't controlled for here is just eligibility standards, time period, the underwriting rules. We haven't controlled and looked at what are borrower-specific factors as opposed to just the fact that you might be low-income or high-income borrower, right? And so that's what we tried doing in the next table. So here what we've done is we run a whole series of regressions, and it's explained in the paper much better than I can explain it here or remember it this time in the morning. But you'll see that what we've done is we try to look at what the impact is of, first of all, just what your income is, and then we add controls, right? And as it's listed below, we're adding the types of controls that the lender would have and you'd had at origination. So we're trying to measure, after you control for the borrower attributes, the location of the loan, because lenders are allowed to have overlays that go down to the CBSA. They can't go any finer than that, so we can control down to geography. Time period, these other things we list here, the presence of subordinate financing, number of borrowers, all these other things, how much of that variation between very low income and high income or middle income and high income can be explained away by these borrower-specific and time period-specific characteristics. And we do that in two different methods of doing it. One is direct control, and the other is two-step. It's just a two-step approach where we use the error terms and then model those, pretty standard. And you can see that you start out with these roll numbers that to go to the current originations, the 2011, 2013 on the right, right, where we saw that just in of themselves, they're 4 times riskier, a very low income to someone under 50 AMI, on average is 4 times riskier than to a high income. Once you control for the attributes of that loan, it drops to 1.8, right, or 1.6, depending on your statistical technique. And what you can see from the little stars is that as you start controlling for the factors, and these are all for loans that are currently eligible today. So we're just using the bottom part of that table, right? We're focusing on loans. In the history, we're only taking loans that would be eligible today. But you can see that once you control for borrower-specific characteristics, the relative risk diminishes substantially. But it doesn't disappear entirely. But it drops pretty far, right? You go from 4 to 1.6. For those between 50 and 80 AMI, you go from 2.3 to 1.1. And it's still statistically significant for the very low income, but for the moderate income and low income, it's not anymore in the current underwriting. So to get back to the first question the lenders were asking me, which is, okay, at origination, is the performance of low income and very low income loans predictable, or do we not have the data to be able to analyze accurately at origination what that performance will be? So to try and answer that question, what we did here is something pretty straightforward. We took a look at, again, the 3 time periods that I've told you about. We're looking at the eligible loans, and we say, okay, what would the models, if you had just that data at origination, what would you predict would be the default rate in this 24-month period? What would you expect the performance to be? And then what was the actual performance? And how much remains unexplained? And in each one of these boxes, you can see the actual default rate is the light blue, the forecasted default rate is the dark blue, and then the difference, the unexplained risk, is in the line. And basically the bottom line of these charts is that you can explain most of the risk in all the groups. You get really pretty close to what it is, right? And you don't have very large differences. If you look at the 100 AMI and on the right, for example, first of all, the numbers are really small, right? Today's loans are performing so well that it's really hard in some ways to predict because just 1 or 2 going bad, even in a large sample, is gonna drive your numbers. But you can see, even looking back further, that by and large, for everybody except the very low-income loans, the data you have at origination allows you to do a very close prediction of how that loan's gonna behave. And for the ones where you don't have it, the differences range from 33% today down to 21% for that crisis cohort, and then 23% for the pre-crisis cohort. So there is still an unexplained performance, but it's 20 to 30%. It's not 3 times or something after you control for borrower characteristics. So this kind of gives hopefully all the punchlines that I've hit on during the presentation, and I'll pass it on to my fellow panelists. Thank you.
Thank you very much for the invitation to be at this very interesting conference. It's a pleasure to present this paper. This is a paper in which we are going to study the effects of liquidity regulations in mortgage markets. So when you think on the post-crisis reaction, we have a very new regulation. So far, the banking industry was mostly subject to capital regulation. After the crisis, there is a broad consensus that the financial crisis have to do with runs. And the way to prevent runs is to have a new type of regulation that is going to be the liquidity regulation. So the way this is done is that the new policy is called the liquidity coverage ratio. And basically what this new policy does is to impose on the large financial institutions that they have to hold enough liquid assets. And then the question is, how do we define liquid assets? And the way this was done is to assign numbers to different assets. This in the US was implemented giving treasuries, and government debt always has the best rating in terms of liquidity. And when we move to the US and we have the mortgage-backed securities, Ginnie Mae mortgage-backed securities, in Ginnie Mae is considered to be basically the government, got the best rating in terms of liquidity is 1. But the Gses, since we don't know really what they are, okay, they got like a kind of a liquidity penalty, and the liquidity weight was 0.85. It means that if you are a financial institution and you hold Gses, for each dollar that you have in the security only counts 0.85, when if you have $1 of GNMI, it counts 1. So you see that there are better liquidity properties because the regulators decided this way for GNMI mortgage-backed securities. This was announced in October 2013. The rule was finalized in September 2014. This is a paper, it's an academic paper that tries to answer 2 questions. The first one, is the market pricing the better liquidity properties of GNMI mortgage-backed securities relative to the Gses? You are going to see our answer is yes, markets price liquidity regulation. And the second question is, does this matter? Does this have any kind of a spillover effect? We want to test the following theory. There is a direct channel. This direct channel is that financial institutions, they care about liquidity because they are subject to liquidity regulation. So this means that they are going to increase the demand for the securities, for the assets that they have liquidity properties. So you are going to expect to see an increase in the demand for the assets with good properties. All mortgage-backed security, agency mortgage-backed securities have properties, but especially GNMI, okay? So you see this increase. If you see the increase there, even the financial institutions that are not subject to the regulation may say, maybe one day I'm going to be subject to the regulation, or maybe prices are going up, so I'm going also to increase my demand. So you see, this is the direct channel. There should be an increase in the prices of the securities because there is demand for them, controlling for everything else. I'm going to show you some econometry work to control for everything else. Good. This implies that there are changes in prices or in the demand in the market. And we believe this is important because this is going to trigger channels that are maybe not so obvious, but we are going to try to provide evidence that they are there. And these channels, we put 2 names. One is the collateral channel, the other is the market liquidity channel. What is the idea? And this is going to play an important role for the lenders that are going to be securitizing, okay? So the idea of the collateral channel is that now mortgage-backed securities with good liquidity properties, they have a higher price. Since they have a higher price, it means that you can borrow more against them because the price is higher. It's the standard collateral channel that we associate with house prices. When house prices go up, we say people borrow more against the house. Well, if you think on MBS, this is also possible. And the second channel is that if there is more demand for these securities, it means that the market is going to be even more liquid. So it means that it's going to be even easier to sell this. And we think this is especially important for non-banks because the business model of non-banks is we don't have deposits, so we give the loans, we finance this with credit lines from banks or in the repo market, so it means that we are using the securities as collateral, and for us, for the non-banks, it's important to be able to sell the MBS. So it means that especially non-banks are going to be affected by this kind of general equilibrium channels. Also lenders that are into the originate to distribute model should be affected by this. Why I think it's important that we focus on non-banks is because we know that before the crisis, non-banks were especially important in the subprime segment. So these are the names that, I mean, here everybody is familiar with them. Even households, people are now familiar in the US with them because you see them in the movies about the crisis, okay? And we have now academic work that the presence of non-banks, it play a role with the lending standards in the market, okay? So that's why people say we need to care about non-banks because they may affect other institutions and they didn't have access to the liquidity facilities of the Fed, okay? Something very interesting is that when you look non-banks, before the crisis they were playing a role. With the crisis, basically, they disappear, but they are back. And they play a larger role now than before the crisis. The next slide to me is fantastic because this shows the US financial system, how creative it is. These are the new non-banks. As you can see, most of the names are new. People told me anecdotal evidence that many of the people working here, they live in Southern California and they were working in the previous one. But these are new institutions, okay? I'm very curious to know if this is true or not, okay? And as you can see, these new institutions, they play a role in the big market, but if you go to FHA, they are the FHA market in terms of originations. You see, the share is basically 80%. It means that If you want to discuss mortgage markets, I think non-banks are important, but if you want to talk about FHA, you should only care about non-banks, okay? That's why I think that these channels that I have discussed before, they can be potentially important to explain why this is going up. Because this is a big question, is why do we see this increase in the share of the non-banks? To give you a preview of my results, we are going to find that markets price the liquidity properties, okay? And the estimates that we find is that if you have a property with 100 liquidity regulatory properties, the market price of these liquidity properties is 25 basis points. To give an idea of this is big, this is small, we have tried to study a lot what is the effect of quantitative easing in the markets, okay? You have, for example, a paper by Krishnamurthy and Bisin Jorgensen, which they try to study quantitative easing one. Well, the result that we find is 25% of the estimates that the literature attributes to quantitative easing. So I don't think it's 25 is trivial of a very important policy. Then we quantify a 10% increase in the price of Ginnie Mae mortgage-backed securities relative to the Gses. And then we go to the other channels, we find consistent and solid evidence that liquidity regulation has encouraged non-banks to move into FHA, to relax lending standards, to originate more, this implies less denials, and to go to the risk-taking part of the market. That means we use HOMDA data in which we don't have the FICO score, but minorities are a very good proxy for the FICO score, and what we see is that the relaxation of standards seems to be happening especially in minorities and in high loan-to-income loans. That from research from other papers in this conference, we know that this is a good proxy for risk-taking. We found an interesting result, is that there seems to be a crowding out effect going on between FHA and the Gses, and it makes sense because basically regulation is encouraging FHA versus the Gses, and when you say, give me a number of how much this matters for the increase in non-banks, we found that this can explain maybe 26% of the increase. Other people claim that better technology, regulatory arbitrage are other reasons why non-banks have been growing. We agree with them because we think that we have to explain also the other 75. But explaining 25, I think, is non-trivial. And then, so far the paper looks a bit negative on the non-banks, but we wanted to see how this increase in the non-banks is affecting also other areas of the economy, and we study homeownership. And as you know, one of the puzzles of the crisis, of the post-crisis, is that house prices recover, but homeownership didn't recover. And what we can see is that the non-banks helped homeownership to recover a little bit. Without the non-banks, the collapse in homeownership would have been even larger. Okay. So as I say, this is a very active area of research. Okay, and we think that what makes this paper special is that shows that liquidity regulation is priced in the markets, and this has a spillover effects for who are the players in these markets. So to show you some pictures that I think are interesting. So this is evidence of the direct channel. Here we go to the call reports, and we look at the banks that are affected by the regulation, how are they changing the holdings. If you see the red line, these are the increases in Ginnie Mae, and this solid line is when the policy is announced. Obviously, the institutions that are affected by this, they say, we are going to buy the securities that we need to buy. Okay, so you really see this big increase. You also see the increase in the blue line, that these are the Gses MBS, but it's smaller. No? And then when you try to look evidence of prices, I like this picture a lot, in which we try to compare ETF that are in Gses MBS versus in Ginnie Mae MBS. Again, the solid line there is when the policy is announced, and you can see a premium there. Okay? Then we are going to do econometric analysis to control for everything else. People in the industry, everybody tell us, you need to do this controlling for prepayment risk. That's why we believe that option-adjusted spread is the right way to study these spreads. Again, if you plot them, you see that the policy seems to be anticipated a little bit. This makes sense. Washington people know that things are coming, okay? And we see this change associated with the policy. And I don't know what happened to my slides. When they converted this to the screen, they... Okay, don't forget the equation. The intuition is the following. How do we do... How do you control for everything else? So the intuition is that when you announce the policy, if you control for the other candidates, you can see how the prices of the Ginnie Mae versus the Gses is changing. We like a lot to do this with option adjusted spread, and we play with time windows, like a few days, okay, after the policy, and we keep expanding the time window. This is what we see here in the window. Something very nice when you run these regressions is that you see at some moment the results converge. You see they converge basically to 25 basis points. So this means that the market, maybe at the beginning, we get some noise in the estimates, but at some moment, they get very stable. Okay? And we are controlling for other factors that could be driving this. That's what gives us some confidence that this is really a liquidity premium that is there. And if you try to do different ways, you do this with only MBS and prices, you do this putting AAA bonds that don't have really too much credit risk, the results are very consistent. So let me jump over these slides and say there seems to be evidence that the markets are pricing liquidity properties. And now we thought it's interesting to see what are the implications for how the lenders react to this. This is what we call the cross-sectional analysis. So I have another equation in which probably we cannot see too much, but our intuition is the following. This is basically a shock to the markets, because as you say, it's increasing the mortgage-backed securities prices, and it's changing the liquidity in the market. Now the question, who are the lenders who should be reacting the most? It should be the lenders that rely more on the securitization channel. And these lenders, we are going to use three types of them. We are going to use the lenders that are non-banks, because by definition they don't have deposits. We are going to use the lenders that well before the policy, they were more exposed to securitization. Why? Because we know that the policy may change the incentives. But if you are very exposed to securitization well before the policy, it's very likely you are still exposed to securitization. So this allows to identify the effects. And then we are going to look for the banks that they have less deposits to assets. Because if you have less deposits to assets, maybe you rely more on other business model to fund your loans. And when we run the estimation controlling for demand, for all the alternative controls, and the nice thing of doing this with banks is that you can control for basically everything you have in your mind, okay, the results are extremely consistent with the theory. You do this with the non-banks, you get always that the lending standards measured by denial rate gets negative. So it means that they deny less loan applications following this policy. You do this with, this is with non-banks, non-depository institutions. You do this with securitization rate ex ante, okay, you get also negative effects. You do this with the banks that are funding the loans with less deposits, you get the same result. So you see different pieces of evidence are suggesting that this policy encourages lenders to deny less applications. You say, I don't like to do this with denials, I like to do this with originations. Well, you did that, we get exactly the same result. Now you expect positive coefficients, but you see that the lenders originate more loans. We did plenty of robustness check, because people usually ask, what if you are identifying something else? And people are very usually interested, maybe you are identifying monetary policy with the Fed. Well, the Fed didn't change the ratio of the demand between Gini mice and Gses, so we are very confident. You can read in the paper all the robustness tests that the results are there, and I think this is a very interesting part. Our evidence is that this is inducing risk-taking in FHA, because what we see is that the standards go down, especially for the minorities. Minorities here are Black and Latinos, and for the loan-to-income. And you see our different proxies of non-bank securitizations, banks that they have less deposits, they all go into the same results. The numbers may change a little bit, but the signs are always in the same direction. And what happened now? Oh. Then we found this effect of crowding out between the Gses and FHA, and then I want to go to this slide, because I think we need to open this conversation about the role of non-banks in the system. As I said, the Fed played a very important role with liquidity facilities during the last crisis, and non-banks don't have access to them. And I think there is a view that non-banks are bad, and we did this exercise in which we tried to say, well, given that we can explain the growth of non-banks, let's see how non-banks affected to homeownership rate. That is maybe a proxy for social welfare. And what we found is that the presence of the non-banks and this policy through the non-banks has been very beneficial to encourage homeownership, okay? And I say this is something that it has been collapsing. So basically the conclusion of the paper is the first one maybe is expected. No, you create a new policy that is creating good properties for some assets, markets price the new policy. This is This is not surprising maybe, but we can quantify this. What we think is very important is to understand that policies that change prices and liquidity conditions in markets can generate unintended consequences. And here the unintended consequence is that the business model of originate to distribute is much more interesting, and the non-banks have been long into that business model, and the non-bank market share in FHA has increased, part of this attributed to this. So we believe this is important because maybe this policy has reduced runs in the system, so this is probably the good thing of the policy, but the policy may be increasing the credit risk for basically for US taxpayers, because basically US taxpayers back FHA, and it's going to be very hard for FHA to go after the non-banks in case of a crisis, because the non-banks, as you see, they disappear and appear very easily, okay? So we think that these policies, they have created this interesting trade-off in which we have a financial system that maybe is more stable to banks, but the US can get a fiscal shock, because that's how I see losses for the FHA, at a moment in which maybe the fiscal situation of the US is not so clear. And what this means is that maybe when we study financial stability, we need to think also now on fiscal policy. And when usually academics, we like to segment things, and at the end things are connected. And this is the message we try to pass with this paper, is the financial risk is smaller, but the fiscal risk is higher. Okay, that's basically what we show in this paper.
Good morning, everyone. I've completed the first job of the day, and that's not tripping getting up here. Really happy to be part of this panel. Really love both of the papers so far. The analysis that I'm going to present today is on the jumbo conforming interest rate spreads. And this is work with my colleague Tobias Peter. And as always, we had many useful and very enlightening conversations with Ed Pinto. Usual disclaimer, this is our own work, doesn't represent any views of AEI or UCLA. So let me just summarize what we knew before and what we have learned about jumbo conforming spreads. So by jumbo, I just mean loans that have amounts that are above the applicable GSE conforming loan limit for that locality. So there's a lot of research that showed that jumbo loans had higher interest rates than conforming loans before the financial crisis. I've listed a couple papers here, but there could have been another 10 or 15 sites. This was a very well-established result. During the financial crisis, that spread widened. You know, the gap between conforming rates and jumbo rates widened a lot because of the implosion in the private market. So that's also well established. But to my knowledge, there actually isn't any research, at least no published research, on what has happened to the jumbo conforming spread after the financial crisis. And that's what we address in this paper. So our main findings are that since 2014, jumbo rates on closed loans, so I'm going to emphasize closed loans because that's relevant for some of the numbers that I'm going to present later, have been about 25 basis points below GSE rates for loans with the same risk characteristics, which reverses the prior pattern. That's held every year since 2014. I'll show you a chart that shows that this is consistent. The jumbo loans do have a somewhat smaller credit box than the GSEs, so not every borrower is going to be able to access the jumbo market and get that more favorable rate. Nonetheless, for safer loans, the jumbo supply is plentiful and the historic rate advantage for GSEs has disappeared. So just a bit of background on the conforming loan limits for the GSEs. This picture shows the standard loan limit back to 2001, as well as the so-called high-cost area loan limit, which were authorized by Congress in 2008 to help provide credit to parts of the market, the large dollar loans that basically became very difficult to obtain after the implosion of the PLS market. They were intended to be temporary, but they ended up, as many policies are, getting reauthorized multiple times, and there's still, this temporary policy is still with us 9 years later. You can see that there's been some variation over time in the maximum high cost area limit, and some localities, many localities actually have high cost area limits that are between the blue and the red line. The red line is just the maximum. So the data that we use are loan level data that we obtain from CoreLogic. The universe of loans is conventional 30-year fixed rate mortgages to purchase 1 unit primary owner occupied home. So we're again in the purchase loan market, just like with Mark's analysis. The data include Gse loans, portfolio loans, and loans that were packaged into PLS. The originations start in 2001 and run through the middle of 2017 with an earlier end date for the PLS loans, because at the time we did this analysis, we still had somewhat incomplete data for those loans. But we will be updating that shortly. We omit any loans that we can't identify as being either a Gse loan or a portfolio loan. Some of them you can't do that given the data that we have. And we omit any loans that don't have a reported zip code and origination year, because we don't know what the conforming loan limit is for those loans. So what these data allow us to estimate not only the jumbo conforming spread, but also the more specific jumbo Gse spread, which is actually what we're after, because we know for the conforming loans whether they're Gse loans or whether they're private loans. So we can distinguish between the conforming loans that are Gse and not Gse. And the final clean data set includes about 16 million loans. So the methodology we use is entirely standard. We use a regression methodology that regresses the loan interest rate and on loan type, whether it's Gse or jumbo, on a bunch of factors that affect pricing. So the goal is to estimate the spread between a Gse rate and a jumbo rate for loans that have the same risk characteristics, because that's being controlled for with the variables in the regression. For the economists in the audience, this is a standard regression discontinuity approach. So we control for credit score, DTI, LTV, loan size, level of loan documentation, location, presence of private mortgage insurance, and presence of prepayment penalties. And we focus on loans that are between 90% and 110% of the applicable conforming loan limit in that locality. This is the sense in which it's a regression discontinuity, because we're looking at how the interest rate changes in a narrow window around the conforming loan limit, so that we're capturing that effect for the most part, and not other effects that change pricing for loans that are very far away from the limit. For this talk, I'm going to present only the results on the jumbo portfolio to Gse spreads. We do have some limited results on the PLS to Gse spreads, but the data that we've analyzed so far is very partial, so that's really more work to be done. So this one chart really summarizes the whole set of results, and it shows the annual level of the estimated jumbo portfolio to Gse spread year by year from 2001 to 2017. So in the years before the crisis, we replicate the usual result, which is that jumbo loans had interest rates above Gse loans, and the difference on average between 2001 and 2006 was about 25 basis points. That spread then widened during the financial crisis. Again, this is consistent with what other papers have found. And on average, that spread widened to about 57 basis points for 2007 to 2009. In the years immediately post-crisis, it came back down to about 25 basis points. But, and this is our main result, since 2014, the spread has consistently been negative. That is, Gse rates are higher than jumbo rates for loans with the same risk characteristics by about 25 basis points. Pretty much year after year. There's really very little variation in any of the years from 2014 to 2017. So why did the pattern reverse? Well, I think a large part of it is that the GSEs were underpricing credit risk before the crisis, and now the guarantee fees are closer to the pricing for the true risk. So that move up in the guarantee fees reduced the advantage. And it's also possible, though I don't know this for sure, and any lenders in the audience, I'd really be interested in hearing your thoughts. It may be that lenders are bidding very aggressively for these jumbo loans because they're looking for low-risk assets. These are low-risk loans. We'll talk about that in a few minutes, with the possibility of not only building the balance sheet with low-risk assets, but also looking for cross-selling opportunities. So there is still a puzzle to be addressed, given that we've shown that in today's market, jumbo loans are cheaper than GSE loans. Why is it that GSE borrowers, some significant fraction of GSE borrowers, still bunch exactly at the conforming loan limit? That's what this chart shows. It shows the distribution of loan amounts relative to the conforming loan limit for GSE loans. And it's a pretty smooth distribution until you get to the last bar. And the last bar is the loans that are between a 99% and 100% of the applicable conforming loan limit. And there you see a jump. So you shouldn't see that jump if it's cheaper to jump over to the other side by increasing your loan amount by $1,000. So why is it that there is this bunching? Well, there must be some constraint that prevents some borrowers from making that leap into the jumbo market. So one set of constraints would be underwriting constraints. They just wouldn't qualify for a jumbo loan, so we're going to look at that. The other is that it might actually take some time and effort to find a jumbo rate that is 25 basis points below the conforming loan rate at the bank where you filed your loan application. And buying a house is stressful, it takes time, and trying to find that last 10 or 15 or 20 basis points on the mortgage rate, that just may not be a high priority. So we're going to look at whether the offer rates at individual institutions actually have a 25 basis point spread or not. So let's start with this rate shopping point. So the question is, do borrowers have to shop around in the jumbo market to find a rate on a closed loan that's 25 basis points below a GSE rate? And the answer is yes, it appears that they do. The rate spread without shopping is less than 25 basis points. So how do we come to this conclusion? So since May, we've been web scraping every day the offer rates from JP Morgan Chase and Wells Fargo for a bunch of different localities and a bunch of different FICO buckets for rates that are just below and just above the conforming loan limit in those localities. And so what we found is that when we compute that spread for the two lenders, Wells and JP Morgan, the difference is not 25 basis points. It's more like 14 for Wells and 6 for JP Morgan. So if you just try to look at what's available from a given lender with no shopping, you start at Wells Fargo and you ask about jumbo rates versus conforming rates, given your risk characteristics, you're not going to get the 25 basis point spread. You're going to get something smaller. And in fact, in some of the categories, the FICO buckets and some localities, there was no spread at all. So there's obviously some pricing heterogeneity that's going on that makes the 25 require that you actually do some work to get it. And jumbo borrowers are doing that work because that's what we observe in the closed loans, but it's not a freebie where you just ask for 2 quotes from one lender. So the second issue about why there might be some bunching at the loan limit is that the jumbo credit box can constrain some borrowers. So the GSE loans that are at the loan limit and the jumbo loans, they're both low-risk products. On our mortgage risk index calculation, they have risk index values that are low, certainly below the average for all GSE loans. But some of the GSE loans wouldn't get made in the jumbo market. And those borrowers might be getting hung up at that bunching point because they really can't get the loan in the GSE market, in the jumbo market. So we have a table here that shows the characteristics of GSE loans at that loan limit, the ones that were in that tall bar, versus the entire jumbo portfolio market. And the main difference really is in the share of loans that have DTIs above 43%. So the QM limit is at a DTI of 43, and 20% of the Gse loans at the limit have a DTI above 43, but only 2% of the jumbo loans have a DTI above 43. So it's clear from the data that portfolio lenders are not excited about making non-QM loans. So if you are a borrower and you want a loan that has a DTI above 43, your options in the jumbo market are limited. There are also differences on credit score and high LTVs. Those are also less common in the jumbo market, but the main difference really is on the DTI. Nonetheless, the jumbo market is very active. Lots of borrowers are there. According to HMDA data, in 2016, there were $180 billion of jumbo purchase loans originated. So I'd like to circle back as my last slide to this issue about the high cost area limits. As I said at the beginning, they were originally intended to be temporary to fill a crisis need, a hole in the market that the private market was deemed not to be able to fill. But here we are 9 years later, and we still have the high cost area limits. We still have the Gses in conservatorship, but that's a different story. So the question is, could you eliminate those high cost limits? And would that be a useful way to at least begin to try to reinvigorate the private lending market, particularly eventually the PLS market, while shrinking the Gse footprint to kind of force high quality product back into the marketplace that's not already necessarily being held by portfolio lenders. So what are the characteristics of these high balance Gse loans in 2016 that if we got rid of the conforming loan of the high cost area loan limits would have to be funded in the private market? Well, first, they're actually a small share of the Gse market. They're about 5% of the Gse purchase loans by count, so 5% of the borrowers. These borrowers are generally affluent, so if we use HMDA data to calculate incomes of these borrowers, their median income is $150,000. So we're talking about people who generally have substantial wherewithal. And by our calculations, about 70% of the high balance Gse loans would fit inside the current jumbo credit box, with absolutely no change in their down payment or the price of the house purchased. So to get this, we're saying, well, they'd have to be DTI less than or equal to 43 loans, and they'd have to have an overall risk profile that fits what's being offered in the jumbo market today. So about 70% would fit with basically no change in the application. The percentage could be higher if there were changes in the amount of down payment or the size of the house. There might actually be some automatic improvement in getting rid of private mortgage insurance because these loans, many of them have PMI as Gse loans, but the portfolio lenders generally don't require PMI, so you could actually improve your DTI just by that alone. So I raise this because the results that we see about the Gse loans now being more expensive than the jumbo loans, this creates kind of a favorable starting point in terms of pricing for thinking about a migration, at least for this part of the Gse market, back to private lenders. So let me just wrap up. So final thoughts. As we talked about, the historic rate advantage for the Gses has disappeared, with jumbo rates on closed loans being about 25 basis points below Gse loan rates. The jumbo loans do have a somewhat smaller credit box, but nonetheless, jumbo credit supply is very plentiful for low-risk loans. And given the rate advantage in the jumbo market, I think it does really open for discussion whether we should consider reducing or eliminating the high-cost area limits. Okay, thank you.
Thank you, everybody. Again, I'll take my prerogative as a moderator to kind of walk through a couple of points. It's interesting to kind of underline some comments that Pedro made about the LCR. I want to share with you, after the change, with the Ginnie Mae, after the change in LCR regulations, our amount of REMIC activity exploded to the point, because again, you have the LCR, but banks don't like long duration assets, which means they don't like 30 years. So about in 2016, I think approximately 20% of all the new production Ginnie Mae activity went into REMICs. And what happened is the banks would buy the short end, and the Asian life insurance companies bought the long end. And we saw a tremendous explosion. In 2016, I think, if I remember right off the top of my head, I think there was as much REMIC activity done by Ginnie Mae as Fannie and Freddie combined. And that's incredible when you think that Ginnie Mae only did half as much business as new issuance. But again, it's driving this LCR issue. So again, just to underline what Pedro had said, it is an impact on what's happening at Ginnie Mae. Also, too, I want to pass on too, Pedro talked about the non-banks being big into Ginnie Mae. One thing I want to pass along, the reason why the non-banks, I think, are in it, in my time with Ginnie Mae, is the non-banks can handle defaulted servicing better than the banks can. The banks will tell you, they're there for the guy making his payment every month, but if a guy goes delinquent, their costs of servicing go through the roof. And the non-depositories, a lot of them were created to clean up the PLS mess in 2008. That's reading the brand new players. So they have the infrastructure to handle loan mods, everything CFPB requires. So again, it's a pass home. That's, I think, the dynamic that's developing is the more higher risk loans are being handled by the non-depositories because they have the infrastructure, and the stuff that's more high quality, the banks are taking because they don't have the infrastructure, and their costs are just eat them alive if they have much than just 1 or 2% defaulted loans in their portfolio. And again, tying to that, I guess I have a question for you, Mark. The question is, you talked about your different performance of the various low to moderate income. What impact do you have on the servicer? Because we've seen the Ginnie Mae side, servicing is a huge determinant in the default management. And what impact have you seen basically on your numbers on the ability of the servicers to actually service defaulted loans?
So I guess, this particular study doesn't cover the cost of defaulted loans, so I kind of have to move beyond that to talk about it. I think your introduction is entirely right. It's a real issue as to who's good at defaulting, at servicing defaulted loans. And if you look at the MBA data on the cost of servicing loans, there's been a dramatic increase, not only in the cost of originating, but servicing. And you've seen this move to, specialty servicers who focus on managing defaulted loans. So, in terms of the performance that we measured, it really wasn't an impact because we were in the early couple of years.
Okay. And then also, I guess, based on your numbers, your performance is impressive as far as the last couple of years versus you going back, a few years ago. Do you think it's an indication that you've actually over-tightened? The question I guess I have is, how did your default numbers compare from the last couple of years compared, let's say, going back to the 1990s or so forth, prior to a lot of the expansion of the credit, and it's Fannie Mae possibly over-tightened with its guidelines?
Right, and so that's, again, it gets back a little bit to the discussion we were having yesterday about what is the appropriate benchmark, right? Do you look at the early 90s? Do you look at the early 2000s? There's no doubt that the loans that have been originated and purchased and then securitized by Fannie for this cycle are performing a really strong performance. It's better performance than we even had in those early 2000 vintages, right? And I think that's driven by a number of things. That the credit box is what the credit box is. It's still fairly wide. What we see is if you go back to 2010, 2011, you still had a lot of overlays from the MIs from lenders, which somewhat then restrict the use of that credit box. So, my view, looking at the data and looking at the drivers of risk, I think that eliminating the compounding effects that you get when you have multiple risk elements was a really important move in terms of having sustainability, right? And so if you look at the pre-crisis loans, the key lesson is it's one thing if you allow a little bit more LTV, or you move a little down the credit score, or you move up a little bit on DTI. All of those are fairly well understood. When you start compounding those all together, you really get a multiplicative effect. And if you look at those changes that we've made at Fannie, it's really to try and get rid of that risk layering. So, you know, my read of the data is where we are is reasonable for the price we can charge, which is the other part of the discussion that we didn't have yesterday around the baseline, right? Because what's an appropriate baseline is also a function of what is the structure of the industry, and can borrowers actually charge a rate of return that meets some capital market expectation of an economic rate of return, right, and a financial rate of return. So you got to factor those things in. You know, at this point, we're meeting the rate of return hurdles that are set with the regulator, and it is a very strong book. There's no doubt about that.
The last question I have is, Steve, you know, Ed DeMarco started raising guarantee fees pretty dramatically with the GSEs, again, with the idea of trying to make them take away their advantage to the capital markets with the idea. So is your numbers kind of showing that basically the raising of the guarantee fees? You mentioned again they're getting close, but it seems like it appears that actually the guarantee fees are actually comparable, if not even higher, than what the private sector would charge for the credit risk. And so the question I have is, has it happened where actually the GSEs now are actually, to some degree, even overpricing for the credit risk?
Right. So I don't think our results can be taken to address the kind of pinpoint question about whether the G fees, which have risen substantially, have overshot, are exactly where they should be, are still a little too low. That's a range that I don't think we can really address with the results we have, because there's also the portfolio lender behavior side of the equation. And if there really are a strong desire for these types of loans that's driving them to be very aggressive, or they have spillover benefits by having these borrowers, available to sell other products to, or because their deposit rates now are basically zero or close to zero, and so, why not load up on low-risk assets? That can also affect the spread. So without doing a lot more analysis, I don't think our results can tell you whether the G fees are precisely calibrated or not.
Ted, if I can add one thing for the audience, it's that the chart I thought was really helpful, because when we raised the G fees was in that initial period where you saw the change, but since then they've pretty much been pretty similar, or in some parts of the box they've come down as we've adjusted LLPAs and other things. So, and I think the lender point is really key, because I think part of what's driving this is that when we look at bank data and why banks hold loans as opposed to, right, we can't originate, we just buy from banks, so they decide, do they want to hold them, do they want to sell them to us? And they hold a substantial number of conventional conforming loans on their books and choose not to sell them to us. The driver seems to be that they want to keep a certain percentage of their loan portfolio in mortgage. It's as though it's a core element of their business model. And so in years like we've had recently, where bank assets are growing faster than overall mortgage debt, so if you look at bank asset growth and you compare it to the Fed funds, the Federal Reserve's data on mortgage debt outstanding, in those years, basically what you're bringing out is the demand to hold loans in portfolio is quite strong, and they don't necessarily choose to sell them to us, and it makes for a really strong bid in the jumbo market.
Again, those are all my questions. Open up to the floor. Anybody have any questions on the floor? And again, give them, whoever gets to let us know who you are and then your question.
Paul Callum from the Federal Reserve Bank of Philadelphia. I have a question for Steve. It's kind of related to the one you just got, but it seems that your results suggest that the private market opted to have lower price and tighter standards. I mean, it could have opted to just not tighten their standards as much and kind of match or have higher premiums. So why do you think it played out that way, or have you thought about that?
I think it played out that way, but there are lenders here, so I'd like to hear from them too. Because the banks got really burned during the financial crisis, and they're quite risk averse, and servicing is super expensive, like Ted said. So there's a strong demand for low risk mortgage assets, and the mortgages they originate that are not low risk, those mostly they go off the balance sheet. Somebody else guarantees them. So I think that's really the answer. Their appetite for risk is low.
Mark?
I noticed about a month ago that Fannie Mae allowed the total debt to income to move up to 50, and that was still going to be okay for the QM loan. How do you think that's going to shift the mix and the performance of what you showed us today?
So, you know, in making those kind of changes, we always do an analysis of what we think the impact will be on performance. You know, I personally was not involved with that analysis, but I think you would expect that it'll have a marginal impact on performance. That's what I've seen from the data I've looked at. Yes, if you go to a DTI of 50, without compensation, the change that we made was, it used to be the standard DTI limit was 45. We allowed 50 with compensating factors, and now you can get 50 without compensating factors. So all else being equal, you would expect us to get a little bit riskier loans, and those loans to be a little riskier. I think it's going to be a marginal change. One of the reasons is that generally you see borrowers only disclose the amount of information they need to qualify for the loan. So there's a little bit of a feedback loop there where it'll just make it easier to process some loans where it's harder to do that. But at the margin, yeah, that's an increase in the risk that we're taking.
I guess what I found interesting was if you look at the 1990s as baseline, if you would go back to 1990s, I guess probably the total debt, the back-end debt, is probably gone up more than any other single factor. And I just find it interesting, I guess.
Right, and I think that's a really important observation from the public policy perspective because we went on a big trip of adding a lot of debt, and the homeownership rate is kind of back to where we started, right? So, and by we, I mean the country, not just Fannie Mae, right? It was across financial institutions and both administrations of both parties, right? You had this push for homeownership, and you pushed up debt levels significantly. And it was kind of a long trip that left us where we were, but with the consumer having a lot more debt.
Eric?
So one question, this one is rhetorical and pretty charged, is would that support a move in the non-agency space to the extent you got a DU or LP approved up to 50 DTI for QM eligibility? There's a lot of people who would ask that question because of Fannie and Freddie records spell out that the risk is acceptable. Well, would that support an argument to the Bureau? But that's not the question I have because that could last for hours. So Steve, presumably the difference, the spread difference, comes from somewhere. And if you looked at JP and Wells, given their market share, if they're not there, then it's got to come from somewhere. And so a couple of parts to that. One, did you see any differences in the PLS market driving where the interest rate, where the coupon is too small, I think, to make a dent? Mm-hmm. It was coming from either portfolio lenders or banks that are buying from correspondent mm-hmm. lenders. So did you see a difference there? And do you think that, well, what role do you think, I've seen anecdotally that bespoke products for things like private wealth management clients, right? Those clients who are typically wealthier will get better rates. So did you see any discrepancies in who the lenders were, whether they were large banks, non-banks, small banks, where the spread was more noticeable versus others?
We didn't, to answer your last specific question, we didn't really disaggregate this by lender. Don't think we have that information actually in the data set that we've got. But we did a lot of robustness testing where we looked at loans that were further away from the conforming loan limit. We looked only at high cost areas. We looked only at areas with the standard conforming loan limit. And basically, you get the same result. It's a pretty robust result. The spread has turned negative. Sometimes in these runs it was 15 basis points, 30 basis points, but it was always statistically significantly different than zero and in the favor of the Gse loans. Back to what may have been your first question.
I don't want to touch that one.
Oh, no, I don't mean your first, I don't mean your rhetorical question. I thought there were two parts actually to the question you addressed to me.
Oh, for you?
Yeah. No, I'm not answering the first question.
The other question, the guy behind you.
Yeah. So this difference between the 6 basis points or the 14 basis points that we saw at JP or Wells versus the 25 in our analysis, I think that is strictly shopping activity on the part of borrowers. So that if you look at the distribution on any given day of jumbo rates in the marketplace for borrowers of a given credit profile, it's like 50 or 75 basis points wide. So if you search hard to find the bottom end of the distribution, you can find rates that are better than the conforming rate being offered by the first lender that you go to.
Do you think then, any thoughts, because lenders have to run the best X analysis as well.
Mm-hmm.
So do you think it's more, lenders not marketing, or is it borrowers not taking advantage of rate shopping sites or any, again, that's one of the questions that ties to, is there any evidence or is there any information surrounding, where the best rates have been available?
Right. So that's a great question that we didn't address. I know there's someone at the Federal Reserve, a Federal Reserve economist, who's looking at this rate shopping issue. He has some preliminary results for, I think, just the Southern California market that shows that there is a lot of opportunity if you take the time and shop aggressively to improve your rate, particularly in the jumbo market. So, yeah.
Penny?
Mostly for Steve. These are questions. One is on the rate spread when you look at what is being offered publicly versus what is actually happening.
Yes.
It's not necessarily rate shopping, but it's rate negotiating.
Okay.
And so that's a factor that's in there that not speaking for Wells Fargo, just generically, you wouldn't necessarily publicize the lowest rate you are going to allow.
Okay.
So that factors in there.
Okay.
But one of the things that I keep thinking when you're talking about the high cost area limits and is there an argument to drop those, and why does everything congregate around that conforming limit, is I do believe, and I can't prove this, but you probably can.
Okay.
That's why I'm challenging you, is that there's a significant realtor bias to pricing properties to meet the conforming loan limit. And so, because they want, would they want more? Sure, but they want it to close, right? So they take the path of least resistance. And my only concern would be the unintended consequences in the areas where the high-priced ones are today. If those drop back down, that bias is going to kick in and force downward pressure. So that's it's sort of. Do you think that that's something that could happen, or?
I mean, I think it could happen. The costs and benefits of any policy change, there are going to be some winners and some losers. So, none of these things are a win-win for everybody. That could happen. One thing I would just mention before we leave this topic is that there was a substantial decline in the maximum high-cost area loan limit several years ago from like 729, I think, down to 6.25. So that would provide an experiment for what you're saying. And I don't know, for the people who were knowledgeable about what was happening in the market at around that time, whether there were really any significant market disruptions. My sense is that there weren't. And it wasn't a small change in the high-cost area loan limit at that point.
Tom Lamalfa, I have two questions for you this morning, specifically to you, Mark. How surprised are you by the results of Pedro's study conclusions and especially of Steve's? I'm curious as to your response to that. And secondly, Steve, would it be relevant and do you think that we'd see the same conclusions if those loan limits were adjusted down to 400 or 350? what variables would change?
So I guess starting off with Steve's, I wasn't really surprised by it because of what's going on in terms of the demand side from banks, right? Banks a couple of years ago, if you look at the excess reserves, you look at their capitalization levels, et cetera, the banking industry is in terrific condition. You know, it's really come back from the crisis, and it's come back really well. And if you listen to earnings calls a few years ago, people were saying they were looking, as I think Steve was saying, they want these assets and they were looking for them. So the fact that they were bidding for them was consistent. The exact numbers, you know, everybody has a slightly different measure of it. What's going on at the margin is a lot of interesting topics to discuss afterwards. But the basic conclusion, you know, was intuitive as to what I would have expected. And I'm sorry, remind me of your second question.
Oh, it was more directed to Steve, and it had had to do with a further rollback to something substantially below the existing maximum loan amounts. So if that were to be rolled back to 350 or 375 as an example.
Right. So let me answer your question in two different ways. One, even though the results that I've shown today are for jumbo portfolio loans versus Gse loans, we've also done the analysis for conforming portfolio loans relative to Gse loans. So, you know, ones that are more similar in size below 417, since our analysis ended in 2016 for the most part. And you see the same result. The banks are underpricing the Gses by about 1/4 percentage point. So the difference in pricing isn't dependent on really the size of the loan. That we're looking at jumbo portfolio versus conforming portfolio, they're all pretty much underpriced relative to otherwise identical loans purchased by the Gses by about 25 basis points. So then that might have been a little bit of a tangent away from the question that I think you wanted me to answer, which was, you know, if you were to consider reducing the conforming loan limit, not just for the high cost areas down to 424, but everywhere down to a lower number. I mean, I think that would have to be done gradually because there will be disruptions. And, you know, if this is going to be an option that will be taken seriously, I think it has to be done in a way that will allow it to work without disrupting the mortgage market in a very serious way.
If I could just add one thing, I think what this highlights is that in economics, we're most of the time focused on pricing at the margin and changes at the margin because that's where the quantities are moving. They're moving close to the place where you're measuring the elasticity or the price difference. When you start talking about you know, $5 trillion of assets sitting on Gse portfolios, and compare that to bank balance sheets, and you start talking about very large movements, which is what you would get with a large change, I just don't think the marginal pricing tells you much, right? Because it really becomes a capacity issue. And if you think back to the 80s, you know, the S&L industry and other things, the question for the banking industry is, do you really want 60% of your assets in first lien mortgages? Or don't you? And they're the ones who choose, right? They choose, even the non-depositories, they're getting their lines of credit from the banking industry, right? Or they're getting them from Wall Street, which is now the banks. There's no division between the two anymore. And so really the banking industry is deciding what do they want to originate themselves, which goes to the paper you did. Where is it too risky? They don't want to take the key time litigation on FHA or whatever, so they'd rather have the independents do that business. And what do they want to keep on balance sheet, and where do they decide they've reached a capacity limit given how they're managing their earnings and their balance sheets, and therefore they want to securitize and sell to the Gse. So I guess that's the point where I think the paper is really interesting, but it doesn't really help you answer if you're talking about a really large shift in market share.
So to take Eric's question in a glancing blow, Mark, there was a lot of discussion yesterday about increasing demand and what happens at particularly the low end on house prices. And so when let's put the performance to the side, and I have a million questions about that, but we'll go there. There is an arms race roughly going on between Fannie Mae, Freddie Mac, and FHA. It's muted to some extent because of the LLPAs and the requirements for the mortgage insurers, but there's clearly a big area of overlap. And we have seen, as was shown yesterday in some of the slides, the over 95% market has grown substantially for both Fannie and Freddie, since you got very much more aggressive in your underwriting and pricing for that matter. And this 50% DTI is another move in that direction, and is direct competition with FHA. So can you speak to the arms race component of this? That's really a policy issue that has nothing to do with your hurdle for whether this loan's going to perform or not perform, which we could talk about elsewhere, but it really relates to the arms race that we're currently appear to be in, particularly on the low end, which is driving up house prices much faster than is sustainable.
Sure. So I guess my perspective on that is a couple of ones. If you start with where you ended with house prices, I think if you look at housing affordability today, so you've got access to credit and affordability issues, right? And the discussion is often focused on the access to credit part, where's the credit box, but it ignores the affordability part, and it ignores what's going on the supply side. So as I look at the market today, the key issue for low and moderate income Americans who want to become first-time home buyers is the lack of supply, right? We have not been building entry-level housing in this country since before the crisis. If you look at the drop in construction, we had an 80% decline in single-family starts. That has now just come back only to the low of the prior two cycles. So we're still not building anything like enough homes. And when you look at what's being built, it's predominantly above 2,000 square feet and above 2,500. So you're not going to solve the affordability problem by, at the margin, further relaxing credit standards. It just leads to higher house prices, right? Because you just don't have the response. And that's what we're seeing in the data, right? We're seeing house prices rise. In terms of your comments about across the three platforms, right? We have three platforms now, Fannie, Freddie, and Ginnie. All of them, to some degree, controlled by the government. And you know, if you look at the data, which we've looked at over the last day and a half, when I think a great example is when FHA did the MIP Cup, you saw that our housing goals performance deteriorated, right? So at the margin, and just like the analysis you presented around the MIP Cup, I think you presented, you and your co-authors presented, the expected number of pickup wasn't there, because part of it was you just shifted people from Fannie, Freddie over to FHA. And really for the MI, it's Fannie, Freddie, and FHA, right? So I think that substitution effect versus really expanding access to credit. If you want to expand homeownership and access to credit responsibly at this point in the economic cycle, work on the supply. Don't play around a lot more with the traditional credit elements. That would be my personal view.
I have a question for Mark based on Steve's results. In the pre-crisis era, when Fannie Mae execution was always better for a given loan that it would take than private market, the risk of adverse selection was relatively low, since anything that was being produced that qualified for Fannie Mae should get sold to Fannie Mae for the better execution. But if in fact now we have lenders who really have a strong demand, their business model, high quality, high balance loans, for those that are taking loans, Steve was looking at stuff between 90% and 110% of the loan limit. If you're taking stuff just over the loan limit at one interest rate that's lower than the rate they're going to get in a Fannie Mae execution, presumably they would also like to keep the loans just under the loan limit that they could get a higher interest rate on if they meet their credit standards. And the question is now, do you face a much bigger risk, at least in some portion of the spectrum, for adverse selection And what does Fannie Mae do about it to address that? And how does that affect the models you have where you're trying to predict default if that's all based on historical data when you weren't being adversely selected and now you might be?
Right. So I guess I'd say I'm not sure we're never being adversely selected. So the question comes down to, is the extent to which we're adversely selecting getting better or worse? Right. So, you know, I know that from the monitoring perspective, we definitely monitor at the lender level, and when we meet with them, what is the composition of their loans, and then from what we can see from other data sources, what do we think they're originating? And when we see changes around that, that becomes a difficult discussion, right? I mean, I'll let the lenders in the room talk to that too. So it is something we're aware of, you know, and try to manage. I think the other part of the question is really relevant too, which is the lenders can originate. You can look in data in HMDA and say, okay, this is originated conventional conforming, but then they can choose not to sell it to the GSEs for a week, for a month, for 2 years, whatever their thing, whatever their balance sheet management strategy is in that time period. As to why they do and they don't, it sort of depends partly where we are in the cycle and where they are, right? There's a theory that dent and scratch loans that otherwise look pretty good, but there's something wrong with the file. When they're done with the post-closing QC, they're like, we're not going to deliver that one, right? Or are they really keeping the best loans? I think the data I've seen on adverse selection is I think the adverse selection that was going on pre-crisis was really strong with PLS, where people were clearly originating loans that they would not have kept in their books and was selling them to PLS. That's where, at least in the academic studies, where I think that was happening the most. I think that's happening a lot less now with and they may even be keeping some of these dent and scratches, you know, post QC rather than sending us the weaker loans. But it's always an issue.
If there's not any other questions, again, I really want to thank the panel. It was great, informative, and let's all give them an applause. Thank you.
Can I ask you a question?
Yeah.
Because you
that was great.
fact, some of the performance data.
He has certainly had
Good morning, everybody. Whoa. So glad Ed put the best panel for last. So hopefully we'll try to maintain your attention here. Our topic of our panel is collateral matters. And I'm going to, oh, by the way, I'm Joan Trice, and I'm the CEO of Altera Group and Clearbox LLC. And I have a fantastic panel. Ted Durant has been with the Mortgage Guarantee Insurance Corporation for more than 20 years and is currently the Vice President of Model Development and Portfolio Analytics. As the nation's oldest provider of private mortgage insurance, MGIC has a considerable interest in statistical analysis and forecasting of home prices, prepayment, and default risk. The analytics services team at MGIC provides those tools to internal users and to MGIC's clients. In addition to his work at MGIC, Mr. Durant has experience in oil and gas exploration, real estate development, chocolate manufacturing, and bicycle manufacturing and retailing. He earned his MBA at real estate from the Wharton School at the University of Pennsylvania and his BA in economics from Carleton College. He now serves on the board of directors of Here, Wisconsin in Milwaukee. My next panelist is Tom Showalter. Tom has held executive positions in product and model management and development, risk management, marketing and sales, information products, financial services development, analytics, asset management. Mr. Showalter has held positions with or has performed professional services for industry-leading firms such as Compex Systems, Household International, Wells Fargo, Bank of America, Fannie, Freddie, JP Morgan Chase, and Citibank. He also served as a military officer and engineer for NASA. Currently, Mr. Showalter serves as the vice president of, oh, excuse me. I skipped ahead, Tom.
It's all right. I'm still here.
I'm having a hard time reading this morning. Hopefully I can figure out my slides in 24-point font.
How about I left the corporate world, started my own firm, and now I'm here?
Oh, wow. There we go. I have really long bios. These guys all have illustrious careers. So Hamilton, I'm going to actually not finish with where you went to school. I'm going to start with Go Tar Heels.
Okay. All right.
Hamilton provides the forecasts of loan volume and profiles to various business units of Fannie Mae. He is an expert on regional housing risks, the transmission of macro developments through the mortgage market, and issues related to mortgage risks and cash flows. Before joining the economics group, Dr. Fought worked in the underwriting and pricing division of Fannie Mae, focusing on issues related to collateral risk. In his role, he had primary responsibility for tracking and reporting on regional risks in Fannie Mae's credit portfolio and developing property level and loan level risk models. Before joining Fannie, he worked as an assistant professor at Kansas State University. You don't even look old enough to, yeah, okay.
Yeah, don't we all?
Yes, very, very good, Tom. His research at Kansas State focused on issues involving dynamic learning and the transmission of technology shocks throughout the macro economy. And last but not least is my friend Bill King. Bill is President and Chief Valuation Officer at Real Info, Inc. He is a licensed real estate broker and certified residential real estate appraiser in Washington State. And he is a nationally recognized instructor of real estate and appraisal courses and seminars. He has more than 35 years experience in real estate and valuation and has served as a forensic expert on valuation and housing issues in local, regional, and national cases. And Bill's title today is, Bill? I don't even see it on here.
You started with it.
Real info, I'm sorry. That was my conclusion at the beginning. I'm going to give you a quick introduction to the topic, and forgive me, I'm not going to jump the shark here and risk tripping. Verbally. The slide in front of you, the greater fool theory, is where I think the appraisal process has devolved to today. And what I mean by that is, as you can see, here's the definition. I'm sure you have all heard of the greater fool theory before, but the appraisal process has the three approaches to value, and I think all three legs of those stools are highly valuable. There's the cost approach, the income approach, and the sales comparison approach. And depending on property type, age, whether it's new construction, price range, and so on, depends on whether or not or which one of those approaches would be the most reliable. So here's actually the codified definition of market value, and there's a couple of things that I think are noteworthy that we completely ignore. Now, one is you have a buyer and seller typically motivated. I think in today's mortgage lending world, that's pretty much where we stop, where you have parties who are well informed, they agree upon a price, and then we're lending not on value, but on sale price. And practically every single model that I've seen, and every economist in this room, is using sale price as the input for value. So Ed and I have actually talked about whether or not in the future we want to spend a considerable amount of time just on this topic alone, because this is the beginning of the mortgage process. This is what the appraiser is solving for. So one of the things in there talks about seller concessions. So you're supposed to have a property value unaffected by seller concessions. Well, Bill's going to talk about the impact of what happens when you ignore seller concessions. We also make the assumption that the payment is in terms of US dollars or financial arrangements comparable thereto. I'm not sure there's anything comparable to cash. If anybody can tell me that applying for a loan is the equivalent of cash, I'd love to hear your theories. And each, of course, acting in their best interest, but it also says that it's the price is unaffected by undue stimulus. And I can't begin to suggest how you would calculate it, but certainly, and I think I've seen a slide where Ted presents where he talks about the TED factor. Ted, is that? Yeah, the crazy underwriting. That affects property values. So my thesis is the difference between the sale price and the market value is the risk. And again, the appraisal process has just been devolved into one approach to value, the sale price approach to value. And we really are not having the appraiser ask the right questions, so no wonder you're getting unreliable answers. So with that, I am going to turn it over to Ted.
Thanks, Joan. And Ed, thanks for inviting me back again. Obviously, I must not have done something terribly wrong last time I spoke to get an invitation back. I'm going to apologize now. My wife's a preschool teacher, so every year this time of year she brings something home from preschool, and I'm sick for a couple of weeks, and I'm just getting over that now. Putting the V back in LTV, talking about collateral matters, what I'd like to do is first talk about motivation. As mentioned, I work at MGIC. We're a private mortgage insurer. Therefore, we are and have been for 6 decades now a buy and hold investor in mortgage credit risk. Property valuation obviously is a big part of that. Both the GSE charters and bank capital rules use LTV as a key trigger for requiring or providing incentives to use mortgage insurance. Therefore, loan-to-value ratio is a driver both of how big we are as a company, as an industry, and the risk we take. So I want to walk through topics of interest in the form of several academic papers that I've read recently that I thought were relevant to this issue of how important is valuation. I'm going to fly through those fairly quickly to get to the last part, which you notice has my last name on it. It's not a published paper, but there's some stuff I want to show you about looking at purchase versus refi and talking about relative LTV valuations there. So the first paper, explaining the housing boom and bust, and this paper I don't think comes to any surprising conclusions, particularly to the people in this room who are obviously all very well schooled in the housing boom and bust, the things that caused it and the impacts of it. It's an interesting model of the U.S. economy, aggregate shocks that generate fluctuations in equilibrium house prices. It's a fairly typical macroeconomic model built up from micro kinds of behavioral simulations. The factors being income, housing, finance conditions, and interestingly, beliefs about future housing demand. Notice they say demand, not prices. I found that interesting. The main takeaway, driver of movements in house prices was result in shift in beliefs about housing demand. And again, focus on that word demand, not future beliefs in housing prices, which yesterday we saw some stuff about sort of the past year's growth in house prices was built into people's expectations about the next year's growth. This was about your expectations about future demand. My takeaway number one, this is Newtonian physics for housing markets, right? I mean, this is fundamental, it's unavoidable, inescapable. Sticky supply, fast-moving demand, and the inevitable results of that, which are short-term dislocations in pricing and markets, which over the long term ultimately will come back to some long-term trend. When we talk short-term in housing markets, we're talking 5 years, 10 years, 20 years, right? These can be actually pretty long-term dislocations that happen. There's also this inertia and overshooting kind of effect. Takeaway number two, housing markets aren't necessarily inefficient, right? So when we observe this kind of mania and we call it a bubble and we talk about that as proof that the housing markets are inefficient, buyers aren't rational, this paper made me look at that again and think, this focus on expectations about future housing demand as opposed to prices actually is supporting the idea that this actually is pretty rational, right? If you believe that housing demand will continue to increase, and there's no reason why you shouldn't believe that if it's 2006 and we are hitting that 70% home ownership rate and it's still going up, right? I mean, what is there to prevent that from continuing to go up? And you know about sticky supply. If you're somebody who's trying to buy a house who doesn't currently own a house, your incentive is buy now, right? And overpay for it because over the long haul, you have expectations that that's a better economic decision than not buying, waiting further. And of course, if you're an investor, you're seeing excess returns, you see continuing increase in demand, continued excess returns, lots of incentive to invest. On the downside, of course, it's the other way around, right? You start to see decreasing demand for housing that has a significant implication for prices continuing to go down. If you're somebody on the outside looking in, you're saying, I'm going to wait, I'm going to watch prices go down a little more. If you're a current homeowner, you might start thinking about, I don't really want to own it anymore and sell. And of course, if you're an investor, time to get out. So next paper, macroprudential tools in Canada. And this topic actually is how I first connected with AEI when Alex Pollock wrote something about countercyclical LTVs. And I sent him an email and said, well, I'm from an MI company and I don't like that. And thus flourished some really interesting conversation. This is a group of authors in Canada, Bank of Canada. Canada provides a nice natural experiment. They actually did lower the allowable LTVs nationally effectively through their controls of the mortgage marketplace. So they have this natural experiment that they can do to estimate the effects of some of these macroprudential policy tools that have been implemented. And they found policies targeting loan to value were far more effective than policies targeting debt service like DTI. So value matters, right? LTV is a very powerful macroprudential tool. My other takeaway from the paper, of course, back to my conversation with Alex Pollock, this is a very blunt instrument, and if it's being wielded by people in a very subjective way, it can have perhaps some unintended consequences. And of course, the other part of the conclusions of the authors is this is a tool that primarily affects first-time home buyers. So we have to be very thoughtful about, okay, it's an effective tool, but who's being hurt by it, and is that the right public policy? Next one, some of my favorite authors in the space, unemployment, negative equity, strategic default. This is an interesting look at some data, a panel study of income dynamics data, which is looking at household level information about their balance sheet and their income statement at the household level and matching that up with mortgage default performance and asking the question about, can we really see strategic defaults versus people who are defaulting for the expected reasons? And their takeaways, unemployment, other negative financial shocks are the key default predictors, meaning the borrower has to have some kind of financial shock really to drive defaults. Another conclusion, only 1/3 of underwater defaulters have enough assets to pay their mortgage. I flip that around and say, yeah, but 1/3 of them do. That's not an insignificant number, and 33% of defaults being strategic defaults, you could say, that's maybe not an outrageous estimate. Some more of their takeaways, 30% of the defaulting households actually experienced an employment loss. 80% had a major shock to the cash flow. So an extra 50%, half the people had some kind of major shock to their cash flow that's not an employment loss. So curious about what is that income shock that's not an employment loss. 40% of them actually believed they had negative equity. So these are some interesting things. My takeaway is something I look at a lot is the fixed costs of exercising the default option matter, that every person in the room has a unique fixed cost that they associate with exercising that default option, and those fixed costs matter. And this is going back to that first paper. In this paper, they look at expectations for future house price appreciation, which I think most researchers tend to look at. And I think looking at it as expectations about demand for housing as a fundamental driver and contrasting that with the slow-moving supply may be a little better way of trying to incorporate that issue. All right, the next paper, information loss and appraisals, and it's great that my friend Paul Kalem's here. He can defend himself if I throw any rocks his way on this paper. So this is using a data set that shows the mortgage application process creates an incentive to substitute the transaction price for the true appraised value when the latter is lower. Obviously, a rich area for some discussion. There's going to be quite a bit more about it. Their takeaways, so this information loss, and I think a big contribution that they've made here is this concept of information loss. How do we measure it? How do we then use that to measure what's going on and the impact that has on risk and pricing? So the information loss may increase the pro-cyclicality of housing booms and busts, very interesting finding. And they say it might be valuable for securitizers and regulators to reevaluate the method for property valuation and perhaps to engage in experimentation. My takeaway is I think we're asking appraisers the wrong question. Sounds familiar to Joan. And I think it'd be valuable to start the experimentation with, say, an already well-known appraisal approach, like going back to the cost approach. All right, last paper, property condition effect, Miller, Sasklars. We now have in appraisals in the UAD this condition score and quality score. And they take a look at the condition score and they find that price spreads for quality differences aren't fully accounted for. They tend to be lower when market conditions are strong. And I think this is an important thing worth sort of looking further into is how valuation characteristics and the way appraisers are doing their jobs change depending on those market conditions. Several more of their takeaways. My key one from this is those quality and condition indicators are really good and interesting, and as an MI company, I'm particularly interested because property condition is not something we insure against, right? So our policies very explicitly say in order to make a claim, you have to have the property in the same condition it was when we insured that. So, so if we go away from appraisals and go to more automated ways, how are we establishing that condition at the beginning of the contract? A very important issue for us. All right, so quick personal example of condition matters. So this is a 1951 mid-century modern overlooking Lake Michigan in 2014, January when it was listed. And this is what it looks like a couple years later after a very stressful 24 months in my life. Condition matters, right? This would be a qualifying property for the researchers who yesterday talked about, you know, how do you value land in, say, Georgetown, right? That nobody's selling land, so this is a full gut rehab. All right, so this last thing, loan purpose and LTV. I haven't published any of this, not certain yet is it going to be published, but I took the Fannie Mae loan performance data and I wanted to look at something that's a very long-running debate within the mortgage industry, which is, are refinances more or less risky? The underwriters and the marketing people say, well, you know, the borrower's been in the house. They're making themselves better off by lowering their rate. Of course it's a less risky loan. And as a modeler, I look at the data and I say, it doesn't work that way. And clearly higher risk there. So my hypothesis is that refi transactions don't have a purchase price as an anchor. And I think we can have a lot of discussion about, you know, whether that's bias or is it an anchor. The fact is it's an arm's length transaction, right? That is the market price that day. Refis, on the other hand, don't have that as an anchor. They're subject to some inflation. Cut right to the chase. My measurement is LTVs are understated by about 9.1 percentage points on a rate term and 18.2 on a cash out. So how did I do this? The Fannie Mae loan performance data, it's what was refreshed on September 22nd. 2001 through 2011 originations allows enough time for seasoning to get some default rates. Kept the DTIs, well, they kept the DTIs under 43, primary occupancy, 11.3 million loans. Nice big data set. Looking at the usual suspects, right? Vintage is important. We can have more conversation like talking to Steve Olin about this yesterday. LTV, combined LTV, credit score purpose. Definition of default, ever 180 DPD or worse. And then there's also a terminated definition, meaning the loan went away. My definition of bad for the modeling people is what I call default termination rate. It's number of defaults divided by the number of terminated, which basically allows for what we call censored observations. These loans haven't had a chance yet to go to default, so we leave them out of the analysis. All right, so the first thing I do is overall some graphical analysis. This is the entire population, and it's going to be a little hard to see. The diamonds, light blue, those are the purchase loans, and across the bottom you have the loan-to-value ratio. Up the left-hand side, it's the log odds of the termination rate. So I'm looking for these linear relationships in log odds. That's why we do logistic regression. Just makes for nice straight lines. The diamonds are the purchase, the squares are the rate term, the triangles are the cash out. And you can see sort of the expected relationship that the Rate terms are a little riskier, and the cash outs noticeably more risky. But this is the entire population, and I want to start drilling in and say, well, I'm going to look at a single vintage. This is 2006, and wow, that really starts to spread out quite a lot. And then I say, okay, now narrow it down to a single credit score range. And this is where I say, okay, this is about the effect I expected to see. The lines are pretty close to parallel. They're spaced apart kind of the way I expected them to be. You'll also notice that the individual dots start to get kind of screwy out there in the high LTV space. A very interesting conversation about signaling and guidelines. In 2006, the maximum LTV for a cash out refi was 95. For rate term refi, it was 97. And so you see the result of those kinds of threshold and signaling effects that go on. All right, this is, now if I look at that for 2003, much narrower. 2011 gets some kind of crossing things. So it seems these kind of vary over time a bit. After the graphical analysis, go into a logistic regression. And this is how I actually measure the effect. And the bottom line is I've got an LTV effect, and I can look at the rate term refi and cash out refi effects as multiples of the LTV effect. And that's how I get the 9.1 and the 18.2. There's also an unknown purpose in there, which I'm keeping for completeness. So here's the final thing is I say, okay, if I add 9.1 percentage points to the LTV for purchase and for refi, rate term refi, and if I add 18.2 to the cash out refi LTV, and I rerun the data, I get exactly the same coefficients on all the other terms, and I get virtually zero coefficients on the purchase and refi. So it basically says you can control for the risk of purpose by simply adjusting the LTV to reflect those differences. So LTV from the papers, from my work, very important metric, both at the loan level risk kind of measuring level and at the policy level, right? Very important in both those places. Obviously, it's flawed in a bit because of these valuation issues, so therefore worth spending some time. And just sort of as a launch into some of the other stuff, this difference that we measure and how you're controlling for that raises a lot of questions about, well, why would those values be overstated for refis versus purchase? I talked about it as not having an anchor, but there are a lot of behavioral questions about the way appraisals are done, the way valuations are being applied that I think will come up. And if we have time, we can have a lot of discussion about sort of why would those distributions of appraised values shift around like that based on purpose. So apologize, I'm a minute over, but
yes. Paramedics needed. Yeah.
The benefits of yoga, good balance.
I would have broke something.
How does this work? All right, good. Can you hear me? Here we go. This is a little bit different kind of piece. It's the result of interviews I've done with secondary market players over the years, primary market originators, other players in the space, and also consumers who are buying. So I'm proposing sort of a hypothetical here, a what if, and if the factors I've identified are substantial, what might their impact be, and what options are there for the industry. I actually get to the valuation issue, which is the topic of the panel, on the last slide, so bear with me, we'll get there. So the first thing I wanted to also say is that one of the underlying assumptions, and especially from the interview data, most people are assuming the market does not have, the mortgage market does not have huge risks in it at this time. Now, for the last few days, we've been hearing quite the contrary, and so I just want to say that this paper assumes a very low risk environment at this time. All right, disruptive change. I think I've identified what I think are three forces. We'll talk about them in a minute. I think if they all mature as as identified, there'll be a new lending opportunity. It'll probably be in the private label non-QM space. There's a lot of talk around that now, but not a lot of action, so we'll see. And if we go to a non-QM play, I talk about 6 elements that'll be needed for that, and one of them is a fix to the current valuation philosophy, so we'll get into that. An underlying theme here is that we've been, since Dodd-Frank and the crisis, in a very high compliant mode. I see hotbeds of innovation around. I think that's going to continue. I think that'll be helpful. The question is whether or not it pays for itself. The 3 forces, okay. They're very simple forces here, and they really have to do with, the first one is consumer demand and political. It's a populism force. What are the people wanting and thinking, and how do they perceive the mortgage industry? And the second one said, or microeconomic. This has to do with whether players in the industry, especially originators, are making any money, and whether the industry at large is growing and prospering, or is it stagnant and sort of, stumbling along. And the third, which you won't have heard in any prior news forecast or analysis for the last 5 years, and I don't think you're going to hear it in the next 3, and that has to do with macroeconomic factors. I happen to believe they're important, but I also happen to believe they're kind of esoteric, and most people don't really talk about them, and they're not really part of the mainstream conversation. But I'm introducing them here because I think they have something to say about our problem. So consumer and political forces. All right. The first thing here is, since the crisis and since Fannie and Freddie went into conservatorship and the FHA and the VA have grown, we have what I call a government-dominated space right now. 97% of the mortgage securities sold on the secondary market are government insured, and 3% or so are not. And so what used to be a large private label space that demanded a fair amount of analytic, both on the buyer and the seller part, is now just a small portion of the loans. And that 3% is a very complex space. There's like 7 different kinds of loans in that 3%, from scratch and dent to jumbo prime to Alt-A to subprime and so forth. So it's a very complex space, but it's a very narrow space. It's forecasted to grow, but it's going to have some obstacles to growth. And I raised the question is, do we really want this kind of an industry? Do we really want an industry where 97% of the loans are government insured? Is that really the way we want to go? And if not, why not? I think it's a complex question with not easy answers, but I think it's one that has to be part of a debate, because I know when the conservatorship versus receivership issue was presented early on, people wanted more of a receivership because they didn't want to get to the place where it looked like the government had nationalized the mortgage industry. So they chose conservatorship because it was only going to be temporary. Well, 9 years later, it's more semi-permanent, and I think we're all on the verge of accepting the metaphor that the government's going to do 97% of the secondary market sales, and I wonder if that's what we want. Another part of the populism factor, we have an administration that's ran in part on a platform of repealing Dodd-Frank, and Secretary Mnuchin has stated as such. And Dodd-Frank has some good effects, and it also had one effect in the secondary market that's very clear. It's created winners and losers. Dodd-Frank has, through its legal machinations, have made it possible for Fannie Mae, Freddie Mac, Ginnie, and FHA to be the winners. Their securities are economically attractive. Private label securities, because of a variety of factors, and also non-QM having a variety of detractors, are less economically viable, and they just don't happen very much. So, one of the questions is this something we want, or do we want to change that? Here's something I talk about. I don't have a whole lot of evidence for, and that's pent-up demand. The turn-down rate's 10%. So one hypothesis is that there's a lot of people who aren't applying. The other part of the hypothesis is people have spotty credit records after coming out of the crisis, and I've illustrated a couple here, and they just don't fit the typical conforming loan paradigm. I had a few properties for sale, and and probably 1 in 3 buyers would actually fit the conforming loan paradigm that came by. 2 out of 3 had some trouble, some spots that would prove irregular for a typical conforming loan, GSE type acceptance. I listed a couple of characteristics here: cash on hand, income qualifications, ability to document income, also recency of some credit issues. And they all led to some form of either turn down or the buyer just walking away and deciding to wait 2 or 3 years until he got well or the industry changed. Microeconomic pressure. This is really having to do with who's making any money. And we're going here to this is the originator segment, and the source is the MBA and the Stratmore Group. And you see that the cost per direct loan is going from $5,600 in 2012 to up to $8,400 in 2016. And of course, Dodd-Frank also capped the fees and did other things to restrict the revenues for the originator. So there's a fair amount of profit pressure in this environment, and it's not working out well for a number of players. So I'm just suggesting that as this pressure increases, because since the thesis is that this cost pressure is driven by increased regulatory issues and increased compliance costs, and since those aren't going away, this cost increase will continue. So at some point, there's going to be, I wouldn't call it a crisis, but a real issue in the origination community about whether or not they can afford to be in this business, and to some extent major banks have decided maybe they can't. So that's an issue, and I think that's one of the factors that's going to provoke some change in the microeconomic side, is people not making enough money to really be in the game. Second part, we've talked about the mortgage industry being stuck at about $1.6 trillion for a number of years. Now the economy is growing, the population is growing, but the industry is not really growing. It's stuck at $1.6 trillion with a few blips here and there. And I would suggest there's a number of factors for that. I talk about lack of nationwide demand. There's spotty places where demand is great, but there's also a lot of places where demand is very weak and thin, and I don't think that makes for the best market. And the bottom line issue there, I put at the bottom, but not because it's the last thing. We have a complex set of GDP trends that have resulted in very slow growth. And that leads us into the macroeconomic issue about if you have a low growing economy where GDP is not growing, are we really generating enough wealth for people to go out and take on a mortgage? And I suspect the answer is maybe not. And let's look at that. Okay, talked about regulatory risk before. One thing here. This macroeconomic analysis has a thesis at the end that suggests improved mortgage lending, given it's within the right risk parameters, can actually help boost GDP growth. And I cite as evidence for that. If you've ever studied recession, recovery since World War II, you'll see 2 factors that get brought up by almost every economist. One is a resurgence in manufacturing, which is more difficult now due to structural effects of manufacturing firms leaving the country. And the second one has to do with the revival of housing and the mortgage industry, which had problems post-crisis due to a number of issues. So I would suggest that 2 things that normally lead to enhanced GDP growth after a recession haven't been present here, and that's one of the reasons why GDP growth is stalled. So conversely, if we could find a way to increase mortgage lending, yes, thank you. This is new to me. And it's late in the game. So anyway, let's go here. I'll get a step ahead now. Here we go. So this graph here actually documents the trends in GDP growth now. Trends in GDP growth from 1990 to 2015. And you see that long-term trends are going from higher to lower, and in the last 5 to 8 years, we haven't broken 3%. So that's a problem. Next slide. This shows one attempt to boost GDP growth was to boost the money supply, which is M2, and that's the tan line. And then you see the blue line, which is the GDP growth from the preceding slide. And you see on the right-hand side, there's GDP growth, and on the left-hand side, there's money supply. But you see the increase in the money supply really didn't put a dent in GDP growth. In fact, it slightly declined as money supply, M2, was increasing. Not the best. This next slide really kind of points out the macroeconomic effect in total, and it really starts talking about the interaction between money supply, which is the blue line, M2, going from the lower left to the upper right, and money velocity, the tan line, M2V, going from the upper left to the lower right. So that means in 2001, we had a high velocity, low money supply economy. And high velocity means lots of commerce. So what you have is economy in 2001 that had the capability to produce wealth. It did, because it had commerce and it had a rapid turnover in money supply, which is all very good. But by the end of the decade and a half, you now have the opposite effect. You have a huge amount of money supply, $13, $14 trillion, and you have almost no money velocity, the lowest in 70 years. And so that's an economy that has trouble generating wealth. And in that period, you'll also note that you had a declining wage growth rate. It went from 3 to 4% per year wage growth down to 1 to 2%, and other factors like that that tend to suggest that this macroeconomic effect is constraining some of the basics of the economy. So, next slide. This one is a very quick slide that just says GDP growth, which is the tan line, and money velocity growth, which is the blue line, are highly correlated and that they're very intimately related. And if you have one that's not really robust, then the other has a problem. And so in typical macroeconomic jargon, M2V times M2 gives you GDP. So it's a very simple equation, and here you just have, since money velocity's been declining, GDP growth can't grow. This last page here just shows what happens if you had continued with money velocity at its pre-2000 level of about 1.8. You have an extra $6 trillion in the economy. Yes, got that. And then redeveloping. So the question is, if mortgage lending is part of the solution to reviving GDP growth and recovering from the recession, how do we get increased lending to happen? And there's two choices. One is to put the government-dominated space on steroids. I think there's a lot of issues with that. And the other one is to open up a private label non-QM space, and there are issues with that, some of which are regulatory. Got to the last page, and here we show just some very simple ideas. Data transparency. The people I interviewed want to see the data from the origination market. They want to see it unfiltered. They want to see it unaltered. They want to see it directly on their doorstep. So that's data transparency to the secondary market. The second thing is data meaning. What these guys are going to start saying is be careful what you wish for, because the people in the origination space are generating 3,000 to 4,000 data elements per loan now. And if you want to ship them all to the secondary market space, who's going to look at those 4,000 elements? And that brings us to the next one. What do those 4,000 elements mean, and how do you make a determination of a loan given 4,000 characteristics? And then finally, data integrity. How is this data transformed and handled to make it meaningful, and how does it retain its integrity? All big issues to the secondary market, because the last time they were dealing with in-text rep lines, which really even didn't deal with the loan level, and now they want to see it all. The valuation issue, which is very important in the secondary market to the people I've talked to, is sustainable property value. In other words, not what's the sales price, but what value can I depend upon for this collateral as we go forward with this loan? And that's a very difficult thing for the industry to handle, and its infrastructure doesn't deal with it well. And finally, the last two, one has to do with regulatory risk. And regulatory risk is that proposed by Dodd-Frank and the CFPB, and it's sort of made the pricing of regulatory risk in the non-QM space extremely difficult to do. So if you have a risk and you can't price for it, it's hard to sell a loan at a risk-adjusted price because they really don't know what the risk is going to cost. And that creates another impediment. And finally, estimates of future loan loss performance and perhaps some form of insurance are a big deal. And I think people are seeing that the same paradigms that were used pre-meltdown for cash flow, loan cash flow, and risk analysis are still in play today, and they'd like to see an upgrade of that. So bottom line is this going to happen? I don't know. Are these forces real? Yes, they are. How important are they? Remains to be seen. But nonetheless, I thank you for your time and appreciate the opportunity, and looking forward to the next speaker, which is Hamilton.
Is it me? Yeah, if we're going in order of the slides.
glad all the steps are white.
All right, thanks, Tom. So first off, let me say I want to present a couple of research projects, some that are in progress and some that you'll see are a little more dated, but I think very relevant. So I should start by saying this is actually joint work with Mark Pelham, who you heard from this morning at Fannie. Eric Rosenblatt, for those of you who've done appraisal research or familiar with collateral underwriter at Fannie. Vincent Yao at Georgia State, and Mike Erickson at University of Cincinnati. I also was able to sneak out of Fannie Mae somehow without a disclaimer, but I do want to put the disclaimer out. These are our views, not the views of Fannie and of Georgia State or University of Cincinnati. So this title, not very exciting, but I think very accurate. So the things that I want to talk about are appraised values and our contract prices. From the three previous speakers, we get the feeling that appraisers are, when they see the contract price, they're kind of substituting the market value for that actual price. I'm not sure how aware people are of the problem, so don't flip ahead, but let me just ask you, how many people think that when an appraiser is given a contract that they're confirming that value? And here I'm talking a purchase, 50% of the time, at least 50% of the time. Okay, at least 60% of the time, 70% of the time, 80% of the time, 90% of the time. Okay, so the distribution dropped maybe at 70. Most people who kind of went in on 50 stayed in at 90. So yeah, the answer, and you'll have to give me a little leeway here, because what we're actually looking at are purchase transactions. So these are actually delivered appraisals. Some appraisals that were low enough to actually break the sale won't make it here, but I'll kind of circle back and get to that question. If you look at, we even had to truncate the axis here. The black is greater than the purchase appraisal, and you'll see this goes up to somewhere around 65%. Then once you stack in the green, which actually exactly confirms the contract price, you're getting close to 95 here at the beginning. So we start in the early 90s. And then, I think very troubling, that value gets all the way up to 98% in 2007. I'll talk a little bit about appraisal reform and kind of what has happened since then. We do see a bit of a drop, but not a lot. And still to this day, I think 90% is a pretty safe number to say if an appraiser is given a contract, and depending on how you cut the data, they're going to confirm that contract price 90% of the time. So the two pieces that I'm going to talk about, we've given them in separate places, and we've given them, so over the years at ARUA. So some of you may have seen these two papers. The reason why I like these two papers is because they deal with the two potential outcomes of what happens when an appraiser has a contract, right? So when an appraiser is given a contract, they can either come in below the value, and we'll see kind of what happens, when they do that, and that's this first paper with Vincent Yao, or in the vast majority of cases, as we've seen, they can confirm that contract price. And so we're going to be interested in that second piece, and that second piece is pretty recent. We just presented it in the summer. What we're going to be interested in is the kind of drivers. How did they actually, what was the mechanism behind how the appraiser confirmed the contract price? So I know that a couple people have talked about uniform appraisal data. Bill, I know you're an expert on this data. We wouldn't be able to answer these questions without this uniform appraisal data. And the uniform appraisal data came about as part of this oversight, this renewed oversight on the appraisal industry following the crisis. And so one of the things that FHFA did was direct the GSEs to gather this data on each of the applications that come to the GSEs. The great thing about the data and how it's going to be able to kind of support what I'm doing, I will see appraisals that don't necessarily result in a consummated transaction. So I can see, for instance, that an appraisal comes in low. It may come in low enough and kind of given the borrower and the seller circumstances to break the sale. The other very interesting thing that we're able to do, and how I'll be able to explain, how does an appraiser behave differently if you give the appraiser the contract versus if you don't? On our REO properties, so the Fannie REO properties, and that may kind of raise the flag, and we can kind of get to that in the Q&A session. On those properties, as we go to market them, we seek an opinion of value from an appraiser. So we actually say, hey, go out, appraise the property without a contract, tell us what you think, go through the whole 1004. And so we get a view what an appraisal would look like without a contract. Then once that property gets under contract, the seller will order an appraisal, we get to see it again. And so here it's a nice experiment to try to say, how was the behavior different on behalf of an appraiser who had the contract versus the one who didn't? And so this is all because we were able to have this rich appraisal data. So let me start with this joint work with Vincent. And if you look at when we wrote this paper, we first wrote it in 2012. I'd like to say that we've made a lot of strides since 2012, but this is really kind of following the process of research. You know, it takes time. So we were actually able to push this, and I should say both of the papers that I'm going to talk about with my time are on our website, and I think they're going to be available on the AEI website kind of over the next couple days. In 2012 and 2013, as we were writing this paper, we were reacting to kind of noise in the industry and signals in the industry, particularly National Association of Realtors was saying that the #1 impediment to a local housing market recovery was appraisals coming in below contract. And so we kind of looked at that and said, okay, wow, how big of a deal is this? So that's the first thing that we're trying to figure out. And then I think more importantly, when an appraisal comes in below contract, what happens? You know, what is the actual result? So the first thing you'll notice, the UAD has some great strengths. You know, I think in terms of the depth of the data you can get from it, it's great. In terms of how far you can trace this back in a time series sense, you can't go very far back. It starts around 2011. So I'm showing you guys a couple of views here. One is just the Fannie deliveries. And I'm looking at the purchases and I'm asking, what % of those purchases do I see appraisals that came in below contract? 2% or more below transaction or contract. So you'll see that line there in 2009, this is the Home Valuation Code of Conduct. This is, you know, ultimately this makes its way into Dodd-Frank, but this is renewed oversight on the appraisal industry. And so we do see a jump up in that share of low appraisals. Now, again, that's censored, right? Because, you know, if the appraisal were low enough to break the sale, it wouldn't make it into the data. So I went back and I looked at our applications in Desktop Underwriter. These are a bit noisy because we can't always be sure that there was an actual appraisal there, but we're looking at appraised value versus the transaction price or what's on the appraisal. And again, we see a jump up. And then finally, I can look at and I can say, well, all right, I don't have a lot of data in UAD, but I have rich data. And so I'm going to say that, you know, again, so one of the conclusions, it's happening about 8% of the time. We're working on extending this data because now we have much more data than when we wrote this. The real takeaway from this research, besides kind of measuring the phenomenon, is what happens when a appraisal comes in below contract. And so the real thing to take away, if you look at other appraisals, so just kind of consider this the vast majority, the 90% of the cases, when the appraisal comes in and confirms the contract price, 65% of the time it transacts at that contract price. Only 8% of the time is there actually a renegotiation of the price down. You know, maybe there was another contingency there, so something happened to make the price go down. When you contrast that with what happens with low appraisals, the real insight here is that when the appraisal comes in below contract, 50% of the time it results in a lowered price, a lowered sale price. So really we see it as a piece of information that enters into the system and allows the borrower a chance to renegotiate. So that's kind of the big finding of this research. I'll quickly breeze through this so I can spend some time on the new paper. I just wanted to show this. You guys can you have the slides with you. You'll be able to kind of refer to these. You know, good research kind of looks at the data and says non-parametrically what does it say, and then, you know, we're putting the statistical models on there and we're making sure that even if we control for other things that this is actually happening. So here the question is, well, when we see appraisals come in below value, and, you know, again, this is maybe up to the panel once we get into it, to what extent are we seeing this now? I think a lot of people have anecdotal stories where they're getting appraisals that come in below value. But what kind of circumstances actually result in appraisals coming in below value? And this is what we were trying to say. The one that I have highlighted here is when we see that the contract price that the buyer and seller have agreed on is above some other measure of value. Here I'm using Fannie's mark-to-market value. Typically, that's when an appraiser is going to be more likely to come in below value. So you can kind of see this as a signal that they might be protecting the borrower or the buyer from overbidding. But other things that happen, you know, that first one there, as the markets are starting to rise, typically appraisers, because they're looking back for their comps, may be more likely to come in below value. When there aren't as many comps available, and when they're relying on distressed comps. So remember, we were writing this back in 2012 when that was an issue. So the second set of results here that I'm showing is now just focused on this idea of, when is a contract renegotiated? So when does the sell price decline? So here the left-hand side is the probability that a sell price is renegotiated down. Key finding here, the low appraisal, when that happens, it dramatically increases the likelihood, just like we saw kind of in the raw view of the data. Here you can roughly say that parameter there in the first column says that the probability goes from something like 8% to something like 50 to 60%. So the more recent research paper that we're looking at, and so this came about, just thinking about this idea of how effective was HVCC, how effective was Dodd-Frank, how effective were all these different regulations and different reforms in the appraisal industry at actually making appraisals and appraisers deliver a value, right, a market value. And so we were kind of looking at this. And again, this is a special sample of our own REO properties. Again, we can see them before a contract price, and so the appraiser goes out and makes an appraisal, and after the contract price. And so what you're looking at here, and this is probably the most interesting slide to understand what this paper is saying. The left-hand side shows the distribution of the appraised value around the ultimate contract price. I think this is the ideal that we dream of, right? That we think an appraiser is going to come out. If that is the true value there in the middle, again, you give me a little leeway here, they're going to come in sometimes above, sometimes below, but it's going to look pretty symmetric, and we're going to get an unbiased estimate of value. Okay, and so that's what happens when the appraiser does not have the contract price. Given the contract price, though, and that's that second distribution, you can see spike at the actual contract price, and hardly anything that comes to the left, every value basically is at or above the contract price. Okay, and so really, again, raw data, we'll go through some models to try to explain, that this is not, just a trick of kind of, non-parametric or showing figures, but this is really what's happening here. Given the contract, appraisers find a way to get to the contract. Okay, so, the question might be, so here I'm losing my advance, okay. Oh, you got it, okay, sorry, it's working. So here what we're looking at, we're trying to figure out how is the appraiser actually doing this. So if you think about the steps of the appraisal process, the appraiser goes out, they have a subject, they're trying to find comparable properties and transactions. Okay, and so they may find the right comparables or comps. All right, and then they're going to adjust the value of those comps. So if the comp is bigger, let's say it's bigger in square footage than the subject property, they're going to adjust the price of that comp down. Okay, and at the end of the appraisal, this is kind of the moment of truth, right? They're sitting there, they have all of their adjusted values sitting on the form, and they say, how do I put all of these adjusted values to come up with the final appraised number? Okay, so here that's the average adjusted comp value. Okay, so one thing you might say is, well, just take the average of the adjusted comp values, right? Don't weight any of these more heavily or not, just take the average. And if you look here, without the contract, this is basically what they're doing. So what you're looking at is the ratio of the average adjusted comp to the contract price. So the red line, they're equal. To the right, the average adjusted comps are bigger and bigger and bigger. The left side, the y-axis here, is the probability that the appraiser is going to go above that value. So here you can see for the pre-contract, they're perfectly fine with just using the average adjusted comp. Right, that's fine. That's exactly what they do. They don't really, with very little probability do they go above that. In the post-contract case, though, given the contract value, when they start out and the adjusted values on average are above the contract price, fine, they don't go above that. But really the kind of smoking gun here, the real discrete break, as things start to get closer and closer to the contract price, and then as just taking the average is going to put you below the contract price, appraisers now reweight. They go to the higher valued comps. And so for us, this was kind of the big conclusion. Even if you get the right comps, even if you get the right adjustments, you still have degrees of freedom to kind of deliver the contract price. So in the interest of time, I'll jump to the conclusion here. So, big takeaways. Vast majority of the purchase appraisals are still confirming contract price. We put the share of low appraisals around 8%. We definitely find evidence of confirmation bias when the appraiser has the contract price. And the mechanism, there are many mechanisms, but one way that we see they're doing it is kind of reweighting the higher valued adjusted comps to deliver the value. So the other thing that I want to point out, and this kind of echoes Ted's point, why does this matter? I think from that first research paper, when we get a true signal of value, and I think the buyer, the lender, other market participants, the guarantor, we need that value. It helps us understand not just the LTV in terms of risk, but in the borrower's case, they get a real piece of information that they can take back to the seller and use it to renegotiate price down. And I think that's obviously some of the research that Paul and others have done. When you have a confirmation of transaction or contract price, you're really losing information. And to the extent that that information is valuable, this is inefficient. There's distortion there. Okay, and I'll turn it over now to Bill to bring us home.
Good morning. Thank you very much for the opportunity to be here. Joan, Ed, Steve, everyone at the American Enterprise Institute. I really appreciate the opportunity. So to bring this to a conclusion, my topic is seller concessions, and in particular, the impact of concessions on property pricing and value. So there are several things I've discovered. This is research that I started in 2013 and have been continuing since that time. So what I have found is that most sales concessions are underreported or not reported at all by both appraisers and real estate agents and brokers. Concessions are not properly adjusted in appraisals when they are reported. And I think that some portion of the price increases that we see in real property are the result of these unreported and unadjusted concessions. So unreported, unadjusted concessions fuel price rises, and they can fuel price speculation, and I'll talk about that in a few minutes. They make affordable housing less affordable. When these things get baked in and start driving up prices, the housing becomes less affordable. And I think that they can also result in underestimated estimates of loan to value. And I think this is particularly important at the securities level. So when these loans are being sold off and being securitized, the loan to value that one thinks they have for that underlying property is probably not quite correct. There are beneficiaries that include everybody involved in loan origination and loan production. If the more you can fuel the process of ongoing transactions, all the people who make money by origination are going to benefit. Agents typically don't have an incentive to disclose concessions, and I think there's another way that this is impacted. Yenling Meyer at FNC did a study a few years ago showing that when appraisers select comparable sales, they are frequently, and I think it was more than 2/3 of the time, the sale price of the comparable was higher than the contract price of the property being appraised. And if you couple that with at least a potential for underestimated adjustments, the indicated value by those higher priced comps may be inflated. So in purchase, my research showed that in purchase transactions, a sales concession is reported by the appraiser about 43% of the time. So when the appraiser analyzes the contract for sale of the property that's being appraised, about 43% of the time they indicate that part of that contract calls for a sales concession to be paid by the seller. But when they're reporting comparable sales, only about 24% of comparable sales show a concession having been paid. And so it raises the question, well, what happened? I mean, in order to be a comp, it typically had to have sold. And so if the properties that were once the subject are now the comps, what's happening to go from 43% to 24%? And I think that some appraisers intentionally avoid comps with concessions because they don't know necessarily how to properly adjust or just simply want to avoid having to deal with that part of the appraisal process. And as I said, we think that there is a tendency for appraisers to select the highest price sales possible to begin with. So we found that only about 55% of the comps with a reported concession have a concession adjustment. So 43% of subjects had a concession, 24% of comps, and only about half of the 24%, when that concession is shown, have an adjustment for that concession. So nearly half of them that sold with a concession essentially have that concession amount baked into the reported sale price of the property. So you have non-realty elements of the transaction being reflected in the value of the real estate as a whole. The average concession amount that was reported in the data that I studied was $4,245, so a little over $4,000 in concessions paid per transaction. And although I don't have it in the slides, the average sale price in those transactions was about $250. When a concession adjustment is made, the average amount of that adjustment was $39.38. So they were adjusting on average almost the whole amount of the concession paid. So about 93% was being adjusted back out. And of course, part of the problem is that when only half of the concessions reported are adjusted, the average concession amount overall is $22.37, or about 53% of the amount that's actually being paid back to buyers. So on average, this $2,000 or so per there's about $2,000 per transaction that's being added to the final sale price that's reported. That is the price at which the property is treated as a comp. So, and this again has nothing to do with the value of the real property. It's an interested party contribution to a buyer. It's a non-realty item that's being baked into the realty cost. The average price of the comparables with the reported concession was $250. I guess I do have it in there. And as I say, that $2,000 is about 0.8% of the $250,000. So the problem is that at the sale at $250,712 was really a sale at $248,712 because of the $2,000 difference. But it's being used, the higher amount is being used to establish the price and value. So it's a price from the broker's perspective. That real estate broker sells the property, has the concession in there, and then when it closes, runs down the street to tell the neighbor that he just sold Bob's house for $250, and by golly, I can get $250 for you. Well, Bob's net proceeds were really based off of $248. So the broker has an incentive to not only have the concession there, but it helps them look good when they're trying to sell their skills down the street. And then the appraiser, of course, is using the higher price as the benchmark for value in the next appraisal. So again, when broker A uses the sale, we have to, when it sells, they're going to do the same thing again. So we're going to get this process repeating downstream. So if it repeats every 90 days, if the sale price is being shown without the concession taken out, and that happens 4 times in a year, we end up with a 3.2% increase in the price being paid that is really attributable to the unreported concession, unadjusted concession, rather than the bona fide price appreciation that would be attributable to real fundamental economic activity. So if you use the rule of 72, which is a really simple way to look at it, it would take just 22.5 years for property prices to double just from unreported concessions. And that's at the 0.8, or excuse me, at the 3.2. So the second part of the problem, and I think the real problem ultimately, is with what's called grossing up the price. So what ends up happening is that the seller says, and I think I have an example of it coming up here. So, but what we don't learn from the appraisal data is how often this happens, because we only know what the contract is as it's being reported in the appraisal. We don't get all of the negotiations that led up to the contract. And so if the price has been increased to cover a concession given back to the buyer, there's nothing in the appraisal about and the analysis of the contract that's going to reflect that. So after there are two ways that this happens, and it's frequent that the buyer and seller will agree on a price and then increase the price for the concession after the initial round of agreement. But the price is grossed up when, after already settling on a price that is presumably the market value, they then conduct this exercise and the concession is added on. So the new increased price becomes the recorded price, and therefore it has the appearance of being the cash equivalent market value before you put that concession into the mix. So as we know, compound interest is the eighth wonder of the world. He who understands it earns it, he who doesn't pays it. And I think that this is a really important thing to keep in mind as we look at it. So here's an example. Property A lists for $185,000, and it is presumably the market value. Okay, we'll operate with that assumption. The buyer offers $185,000, but says to the seller, I need 3% cash back to help with my closing costs, or I can't close the deal. And the seller says, well, that's fine, but my net proceeds and my anticipation of what's going to happen is based on 185. So we're going to mark this up to $190,550 so that I can give you the $5,000 you need for closing. The buyer accepts, the sale closes, it records at $190,000. The broker runs down the street to property B and says, hey, I got $190 for Bob's house. Let's list your property at $190 and we'll get you sold. So that seller sets their expectations for net proceeds based on $190,000. Buyer comes along, they need 3%. That's 3% of a slightly higher number, and we're now at 57. They close at 195, and so what you can see is that this starts to cycle through the market. And of course, all of this is aided and abetted by what Hamilton was showing, which is that there's this tendency for appraisers to confirm the contract price. So it isn't hard to see how this ends up being perpetuated. And of course, owner C might see this as prices rising in their neighborhood, but they don't want to sell their house. They want to refinance and do a cash out. And so the appraiser sees the comps at 190 and 195, and because the 195 is the more recent of those two sales, it's going to get weighted, and the probability is that they're going to look at the $190,000 sale and adjust it for the difference in time between those two to 195, confirming all of this other information in the market. So, and again, what happens is that the presumed 75% LTV on this refi is really 79.4% if you look back at how we got to the 195 to begin with. So the result is, again, if this happens twice a year on this basis where we've got this compounding, all of a sudden prices can double every 12 years just based on the introduction of non-realty elements into the realty transaction. So in aggregate, what does it mean at just 0.8%? If we look at the 2016 mortgage volume at 1.8 trillion, 1.9, and look at what 0.08 or 0.8 concessions impact would have, that's $15 billion of money being created or fabricated by just simply doing a paper transfer from the buyer to the seller. And so I think it's a clear indication that unreported, unadjusted concessions are having a pretty significant impact on our housing finance system. And I finished 2 minutes early because it's almost lunch. But thank you very much.
Nice job.
Thank you, Bill. I have a few questions for my panelists, and then I'll open it up to questions, and I'll keep my questions brief. So, Bill, since you just wrapped yours up, who wins and who loses in that scenario?
Sure. I think the winners include, as I said earlier, the originators and basically anybody who makes more money when there are more deals. First-time buyers as a group are the losers because the prices are ratcheting up at a faster rate than the price band of properties might if these concessions weren't there. The conundrum is that from the individual buyer perspective, as they go through their little decision tree, individual buyers want that help. They need it, they want it. So we have a disconnect between what is good for the group that I belong to versus what is good for the individual members of the group. And how do we go? I don't have an answer as to how we go about changing that behavior, but it is an interesting problem.
All right. And Tom, what do you see as the impetus for change?
Which of those three factors, you mean, for example?
Yes.
I think the populism and the microeconomics are the most emotionally provocative ones. That's when the consumer's not getting what he wants, and when people can't make any money serving the consumer. I think those have a lot of impetus. The only thing I would like to mention about the macroeconomic, I asked yesterday, what can we do to boost income, the I and the DTI, and everybody just laughed. Like, oh, you can't ask that question. And I think the answer is you need to improve the money velocity, and that's a constraining factor on a lot of economics here in the mortgage industry. But I think the things that are going to lead to change are the emotional things that can get a headline, borrowers that can't get a deal, mortgage companies going out of business, mortgage industry that can't grow. I have a feeling those are going to be the emotional, provocative factors, whereas the macro, I think that's actually a huge constraint on growth and prosperity, but I don't think there's a direct reaction to it in the public.
All right, and Ted, a lot of what you talked about was the subjectivity of the appraisal report. Why do you think appraisers don't tell the truth?
So I did not make that assertion.
Yeah. Well, excuse me, the studies you referenced said that it's a subjective process.
So I think, I can avoid making the statement that that the appraisers are intentionally pushing the appraisal one way or the other and still get the same result. That is, if you assume that the appraised value is distributed about the actual market value in some way where it's roughly symmetric, there's some on the left, some on the right, any transaction where that appraisal value comes in low that is going to take that, some increasing proportion of those transactions out of what we can observe then, right? That those transactions don't happen. So there's a very natural statistical effect in which the observed appraised value is greater than the true market value for any of these populations. So I didn't say appraisers lie. I didn't say they misstate.
That was a loaded question. Perhaps I should have rephrased it. What do you see as the misaligned incentives in the appraisal process?
So I think it really gets to the question you're asking, and this question of, what is the market value? As I said, that there's a willing buyer, a willing seller, and this is the price subject to what Bill shows, which is, no, it actually isn't the price, right? I mean, I think you have to take those things into account, but you also then have to say, well, if we've eliminated the cost approach and we've eliminated the income approach and we're only using the market approach, and the very best indication of what this property is worth is this arm's length transaction, it's pretty hard to argue that that's not the market value of the property, right? I mean, that is the arm's length transaction subject to these adjustment problems. But, so in effect, even though it doesn't say it explicitly, I think what we're asking appraisers to do right now in a purchase transaction is to say, can you reasonably come to that value from the available comps? And I think what Hamilton's showing is, the appraisers feel that need to say, well, yeah, if you look at these comps and you adjust them this way, you could reasonably come to that conclusion. I think an area we haven't looked at in all of this is the role of the realtors and, you know, setting the ask, right? So we've talked a lot about sort of bid-ask kinds of things, and the fact is where the ask starts is a realtor does some comp analysis, negotiates with the seller and says, well, here's what I think we should list it for, and sort of typically is going to try to list it, right? You think of probability distribution. I'm going to list it to the right of the expectation in hopes that I get somewhere close to the expectation when buyers come in and negotiate me down. In a buyer's market, right, you know, there's going to be a lot of negotiating down. In seller's markets, and you see this in a lot of markets today, right, the ask price is below the ending contract price, right? You actually get a bunch of people walking into the house day one and they're competing offers, and you actually end up getting something higher. And I'd be interested to see a little more analysis around what's the original ask price from the realtor versus what is the contract price that's initially negotiated versus the ending, right? And does that depend on what kind of a market we're in?
Yeah, in valuation theory, a property's never worth more than what you ask for it. So when you see a list price of $500,000 and ultimate sale price is at $700,000, it's frightening. I know that happens actually fairly frequently these days in Washington, D.C. and the Pacific Northwest, and a friend of mine lives in San Jose, and he's seeing contracts $1 million over ask. Wow. And you know, whether these are cash deals or not, I don't know, but it's yeah. But they in turn become comparable sales ultimately, regardless how they get financed. Hamilton, I have a couple of questions for you, and I'm going to throw them out all at once because I think, well, I think they're all sort of related. So because of HVCC and consequently the appraisal independence requirements, how many appraisers do you have on your do not use list? And what's the enforcement bit around that? So if you've identified this as a problem, what are you doing about it? And then lastly, if indeed appraisals are inflated, doesn't that mean your UCDP data is highly flawed?
I love both of those questions. Thank you so much for those.
So, I love asking
Well, okay.
them.
Well, I love those questions because I can't answer them, but I would try to kind of give some information around. Because one of the things that we didn't talk about, and I would expect if the whole day were spent on appraisals and kind of what's going on in the industry, really is this idea that we've lost a lot of the appraisers to retirement. You know, some of them left as the downturn unfolded and never came back. You know, I think, like I mentioned in my talk, Ted, like you showed, a lot of our experience with appraisals is firsthand, and I think that's where we learn a lot of our lessons. So for instance, I live in Maryland, very close to the DC border, and I did a purchase and a refi as rates kind of went down. And then, you know, but basically the appraiser that was sent to look at my property was from Baltimore, right? And didn't understand the area that we were in. And so part of what I think goes on with appraisers is they're sometimes asked to do the impossible, right? They're kind of spread very thin. They get dropped into a market where they don't have a lot of information, and then they end up in a situation where it feels like instead of them saying like, okay, the guidelines tell me to do market value, right? And I think that's what we all understand. But really, and my research shows it, I think other research shows, this is really kind of those statistical tests of here's the null hypothesis. Here is the value that we have under contract. Can you disprove this? Exactly. Or can you give us some basic support for this? And because of that, I think that's where we've gotten. And you know, because we've gotten there, I think we just need to have our eyes wide open and maybe start saying, okay, this is the reality. Do we want to change it? or do we want to say this is actually what you're getting in terms of a signal of value? Right. I would, is UCDP flawed? The funny thing about, for people, and I haven't been doing this very long, so I joined Fannie in 2010, but even back then, the mortgage data was not great, right? It was before the performance data was released. It was before any UAD data. So over time, the mortgage data has gotten more and more complete. And I think what we're trying to say, and really I think Bill's research and Ted's research shows this, when you're looking at a number, like LTV, right? So, because I would say it's not just use CDP, it would then be all performance data if we think that the LTVs are compromised. I would argue the LTVs probably are less compromised in today's data than they were going even further back because of, there is some scrutiny on the process. So I would say UCDP is probably like any other data set. It has its flaws, and that's kind of what our research is showing, is that this is not a unbiased measure of market value. It in fact is, in a lot of cases, the appraiser going in to confirm. When they don't, the sale is broken or it's renegotiated, and a lot of the data where we would want a lower value just doesn't make its way into the data set.
And Hamilton, I'd like to just add to that with regard to my work in concessions. Everything I did was before, or most of it was before the uniform closing data set went into existence. Yeah. And it's my understanding that with that, you will now be receiving concessions data from the closing documents. And I really would look forward to seeing how things look when you've got that level of data available and how that compares to previous studies.
Yeah, and this is exactly an issue that we're looking at, this seller concession, and the data coming on is going to kind of give us a view onto that. So, yeah. Maybe a future research project for a future panel.
You bet.
Yeah.
Yeah, so even though we say the valuation measure is flawed, and we say, yeah, but the LTV measures maybe are better today, to me, there's this fundamental problem that property value is a probability distribution, not really actually a point value, right? And we've created a number of thresholding effects on the basis of the loan-to-value ratio that, have obvious and big and important impacts on borrower and lender and investor behavior. And if it's a probability distribution, not a point value, we're creating these threshold effects that really are masking a lot of underlying stuff, and we're essentially lying about it. And that's kind of what I was drawing from my research was, you can think of it as that LTV that you're representing for a refi isn't right, and you can solve for that by just simply shifting it, but it really raises a fundamental question around, if we were to change, for example, to a lendable value as the V in LTV, well, throw out all your FICO LTV matrices of default risk, right? Because you just changed the way you're measuring LTV. And thinking about having these hard lines at 80, at 90 LTV, or these underwriting limits that say max cash out at 95 LTV. Well, guess what happens for all those people, right? I think you could rethink the use of LTV in those hard limit ways and think about how do we think of it in terms of a probability distribution instead of point estimates. And yeah, a very rich area for research and thinking, both at the loan level and, as I said, at the very big picture macro policy level.
Okay. Penny has a question. Thank you. Penny, microphone's coming.
And I guess the question is first directed at Hamilton, but it goes to what Ted was just talking about too. Because I get a little worried when I hear the appraisal being referred to as a great tool for the borrower to renegotiate the price, because I think the appraisal is trying to serve too many masters, and I prefer to think of it as the lender's tool to make a credit decision, which it should be a mortgage loan decision. And I mean, just from your perspective, does it worry you when you hear it being used for other purposes that then influence the outcome?
Right. So what is the appraiser supposed to do? I think the appraiser is supposed to give a value, again, and the lender is the one who's ordering that appraisal. So for sure, I think they have obligation to the lender. I think the hope is in just a very clear theoretical construct that we were actually getting a signal of value.
You know, so and so in that case, that's all that I'm saying is that any interested party who wants a signal in value, you know, that should be the ultimate. And to Ted's point, that we're asking too much for a point, right? And I think one of the things that we wrote in the paper was, let's talk about a range, right? And so in some sense, given a range, and again, you know, and that may be part of this way how we kind of relax that they have to serve, you know, several masters. Instead, they're just saying my goal is to kind of confirm the contract, or sorry, talk about some market instead of confirming contract. You know, again though, information to, you know, from our perspective, information to the borrower or buyer is valuable. And I think in that case, they, you know, now they have eyes wide open, I think, in a pure sense, and can say, I want to walk, or can I renegotiate?
Because I know I've had this ongoing dialogue with the realtor side of the equation, and because they tend to view the appraisal as confirming what they negotiated, when that's not its purpose, that creates a lot of the friction. And you know, the one thing I will say to them, I am not opposed to speculation, I just don't want to lend on it. And so the appraisal is for me to lend. It is not, that doesn't mean the sales price they negotiated is wrong at all. And I think somehow we got these two conflated, and it's driving people to do silly things.
Some questions over here.
Just speak as a consumer, not as an economist or Federal Reserve person, but I think who's paying for the appraisal? I mean, shouldn't that count for something if you're paying for it?
I have an answer to that. Because this came up yesterday at FHFA, and I'll tell you, the borrower in most cases is paying the appraisal fee. If instead you ask the lender to pay the appraisal fee, I will put it in the rate. I'm not a nonprofit. So no matter where it is paid for, the borrower is paying for it, right? It's part of the product. Mm-hmm. Why? I can't give them a lot of stuff that I collect in the process. Do you know what I mean? Yeah, it's part of the, it's part of the mortgage process, but people do forget we are required by law to separate fees from rate on certain things, just because everybody wants to know. If we were allowed to lump it all together, it would just be in the rate. But either way, the borrower is paying the full price. That's the cost to get the loan.
Bernie Marksey, I'm an economic consultant. A quick aside before I get to my question, in terms of what Ted was saying, we just have to look at the internet and see the different values to see there's a probability distribution around properties. At the same time, you have a willing buyer and a willing seller, which sets a value. Of course, what you're looking at is what is the risk. So, okay, that's just an aside. Getting back to this appraisal, actually Hamilton really went into my point to some extent, and my question, going into during the boom bubble period, we had appraisers appeared to get in bed with some of the lenders, and that led to, after the bursting of the bubble, to regulations that you had to bring in an independent appraiser. Now, one result of that, particularly coming out of the recession, out of the housing recession, starting up, I don't know how true it is now, and Hamilton just spoke to it, was bringing in the cheapest appraiser, who we would get drive-by appraisals, not knowing the area, where before, when again, we get back to what is normal times. During normal times, the lender and appraisers would work together. They have a set of appraisers. They knew the area, which is Hamilton's point. Because all we have to do is, any of us have to think of a small of your area, wherever you live, then put out a half-mile radius and think of the variation of those neighborhoods and what matters. You bring in an outside appraiser from Baltimore or wherever, they may not even drive, they may not even drive by. They may get on their computer, look at something and so on. I don't know how prevalent that is now. That definitely was, and that was one of the complaints in getting the market together. My question buried in all this, beyond making a statement, is, have there been any studies that look at this? Do we need to rethink the regulatory requirements that have pushed us to that?
Is that the main idea? You got that? Yeah, so part of the reason why we started looking at this was to ask, to what extent had real reforms in the appraisal space actually materialized, and to what extent have they changed behavior? I mean, I think our result stands for itself that, you know, if you think that you're getting some different view than you've gotten previously, that isn't happening, right? I mean, that it is true that the appraiser goes out, has a value, confirms that value. Now, maybe to some extent, you know, it's gotten rid of, you know, some of the things that were more obvious, but still, you know, we can tease out in the data that you're given a choice, you have a contract or you don't, having that contract is driving your behavior. You know, so that's kind of our view, and I know that there are other people who've looked at this and said that appraisal reform had a short-term impact, but that things have kind of gotten back. You know, and again, it's not the risk that happened and that you know and that you saw in the previous crisis that will get you in trouble. It's this other thing that starts creeping up, right? It's like this, now it's seller concessions. It's other things that, you know, reforms have not addressed or we haven't thought about and we haven't set the system up to answer. You know, in some sense, appraisals are confirming value. They were confirming value before the crisis, they're confirming value now. And I don't think the HVCC has, and you know, again, HVCC is really Dodd-Frank. Dodd-Frank has not had that effect of keeping appraisers from confirming contract.
One more thing, if I may add, about appraisers. We did a study when I was at Digital Risk to try to get the degree of precision an appraiser could bring to the problem. In other words, what's the standard error of an appraiser? And we found it to be standard deviation of error was 6–7%. So the confidence limits are going to be roughly plus or minus 12 percentage points north or south of the value. And that's how accurate, quote unquote, or how precise an appraiser could be, given the data he has and the environment he works in, so, or she. And so when we have a lot of deal making that's, as we talked about, using loan to value and precise estimates of value, and you have 97 LTV loans, and then you factor in what's the standard error of the appraisal, you probably have a bunch of 97 LTV loans that are neg equity loans the day they're made in some way. So I think we need to think a lot about the precision of the tools we use and not just the integrity of the appraiser.
All right, with that, I want to say thank you very much, and we will see you same time next year.
So this concludes the 6th Annual Housing Risk Conference. Thank you for your attention and attending. Lunch will be served in the lobby area, but before I close, maybe we should rename housing risk the dismal science instead of economics, because in 1985 at Fannie Mae, we looked at all of these issues relating to cash out refis, rate and term refis, purchase loans, and found that there was a huge discrepancy in the valuations on the one versus the other, which is why we went to a 70 to 75 limit on cash out refis and an 80% limit on rate and term. We also found that seller concessions were hugely a problem and created problems with valuation, which is why we reduced the seller concessions. And in 1990-91, Joan's familiar with this research at GE Mortgage Capital. We found that appraiser bias, you know, all of the problems that have been talked about here were rampant back then, and nothing much has changed, and all of the regulations by and large haven't done a whole lot to change it, because the fundamental process is more or less broken unless you call it what it is, which is you got a sales price. Is there some probability that you could justify that sales price no matter how, even if it's high by 8% or 6%? The answer is yes, and that's what we get. So with that, we will close, and lunch is served in the lobby. Thank you.